Hello and welcome to Technical Analysis Bootcamp course introduction by Wealthy Education. What you'll learn in this course is a complete technical analysis system, how to identify bullish and bearish sentiment, master how to use support and resistance, master how to use technical indicators and oscillators, master how to trade chart patterns, and master how to trade candlestick patterns. And as always at Wealthy Education, you will learn with real-world examples. So sign up for the course, let's get started, and I'll see you on the inside. Hello and welcome to Technical Analysis Bootcamp by Wealthy Education. In this first video, we're going to keep it simple. We're going to talk about the most basic thing that you will need to know, and that's support and resistance. On the TradingView platform, there is a line over here on the side, and if you click on this little arrow, it expands the menu out. I'll be using the horizontal line to draw support and resistance lines. And you can see that if I click on the chart, it pops up. There's a little bubble, which allows me to drag it back and forth. And you click away, and it goes away. So, support and resistance. Support and resistance are simply areas on a chart that buyers or sellers cannot break through. So if you can imagine a stock or any financial instrument for that matter, trying to break above this area here and failing, that is the market resisting price from going higher. The market doing something like this and finding a level where we can't break through to the downside is said to be supporting price. So it's either resisting or supporting an uptrend. It's based upon an uptrend, although it works in both. So you can take this line and you can draw little areas. And the first thing that I would mention is you can see where price was resisted at this area here previously, and a lot of selling pressure came in. But when we broke above it, buyers started supporting the market right in this area as well. And that's something called market memory. So market memory is based upon, and I'll go back to our example here of resistance, but it does work in both directions, of perhaps sellers coming in at this level, $215 in this case, and they continue to sell. Well, what happens when we finally break out? Well, when we finally break out, there are a couple different groups of people that will be noticing this. Number one would be the sellers who are losing money. If the market comes back to test this area, they are willing to get out and perhaps even reverse their position with a smaller loss than they would have had up here. So they have an inclination to close their short positions, which means they have to buy the stock. The other group of traders will be the people who missed the move entirely and are waiting for a cheaper price to get involved, what could be a move higher. One way to think about this, an old axiom, is what was once the ceiling becomes the floor. So think of support and resistance levels on a chart like this, and think of it perhaps as a cross-section of a high-rise. So if you're in the first floor, second floor, third floor, etc., if you go above this resistance, which was the ceiling of the first section, it should now be the floor of the second section, or the second grouping of trading, and so on. So what was once the floor becomes the ceiling if you drop a floor. It's a very similar idea. Support and resistance tends to be found at round numbers. So for this example, you could say maybe 1 to 80. And that's because large order flow tends to happen at large round numbers because, unlike us, some of these large houses are coming in buying millions of shares. So they have to continually buy in this area when it pulls back, because if they buy too many shares in one shot, it'll make the market move against them. Those of us that are retail traders, we don't have that issue. So let's go ahead and take a look at what this looks like in an uptrend. Well, you can see clearly that's somewhere around $140. Apple has been supported in the past. You can also see that we had seen some trouble here. Resistance happened. Now, we did break down below here, but there's also a gap there, which is somewhat supportive. You can see we broke down below here and then turned around to form a hammer, which is a very bullish candlestick. And couldn't even get back down here the next time. So you can see this does tend to repeat itself. And as I draw these lines, you can see that there truly is an order to the market. You know, it's not as random as a lot of people think that it is. Now, does this always work? Well, of course not. There are times where support and resistance fails. But at the end of the day, it gives you a guideline. So typically what we like to do is we like to say, okay, well, we have our lines. You know, we need a candlestick or some type of pattern or something to confirm. So this breakdown in this hammer being formed on this daily candlestick at this level confirms for us that there is support coming in. Another thing that you should pay attention to is on this candlestick, there was a lot of volume. So that shows that there's real strength there. There's real conviction in buying. Or, in this case, it could have been real conviction in selling, but guess what? They're losing money the next day, so they have to short cover. So there are a lot of different ways to look at this. But one thing, you know, here's a bearish engulfing candlestick at 180. You know, the volume wasn't great, but it was a bearish candlestick. So this is a much better signal than this one, but both are certainly valid signals. Another thing that you'll want to pay attention to is that we've been in an uptrend, so this may signal more of a pullback as opposed to a shorting opportunity, because you always want to go with the trend over the longer term. Now I'm going to go ahead and remove all of the lines and talk about Fibonacci. So in this case, I'll go ahead and use General Electric. Fibonacci is a mathematical formula that was discovered by a mathematician many centuries ago named, you guessed it, Fibonacci. And what he recognized is that there were patterns that repeated themselves throughout nature. Now, without going into the math, the idea is that you have a trend up or down, and typically they will pull back before they continue going higher. I mean, that's not a huge surprise. There are specific amounts that they pull back that matter. Now, 50% is not technically a Fibonacci number, but it is used on the tool because 50% is a lot of times people will get involved when it's pulled back halfway. There are other figures to be aware of, 61.8% of the move being pulled back. And then the 38.2% Fibonacci retracement level. And you can see that on the way up from this low, we pulled back right here to the 38.2% Fibonacci. Now the tool is on the pitchfork menu, and it is the retracement. Now there are other forms of Fibonacci that you can get involved in, but in this case, we're just looking at the retracement. So the retracement from there was at the 38. So, like I said, it works in both directions. So the last swing high is what you want to draw this from, or the last peak high. And as I draw this, this has actually hit a minor Fibonacci retracement level, the 78.6. This swing high can be extrapolated down to here. And then there's the 38.2 again. You can see that we fell and then we bounced a bit and sold off. So think of it as a guideline. There are some people out there that will use just Fibonacci. I don't think that's the best use of it. I think it is something that you want to perhaps get involved with adding it to some other form of analysis, like your support and resistance lines. Now, your Fibonacci should be drawn from either a swing high or a swing low. It gets clicked and dragged, and then you just simply look at these areas for support. Again, though, I would caution against using it as your sole indicator. Now, that being said, if you combine an area of obvious support and resistance, on a longer term chart especially, you can perhaps set up potential trades later. So if we are to pull back, in Apple, down here you can see that there is a clear support and resistance area right around $185. So as we drift lower, Fibonacci traders and support and resistance would both give you an idea as to, hey, this may be a great place to trade. You want to be looking for, a hammer, a bullish engulfing candlestick, something like that, a 3 candle pattern, something along the lines of that to really kind of add to your thesis. Because with trading, the best trades are the ones that are based upon multiple reasons. One thing that you will never see us do as professional traders is just to simply take a trade based upon one sole reason. So in this case, the 38, the 185 levels both look to be important. We're in an uptrend, so certainly you don't want to be a seller, even though, we could drop $20, $25 in the short term. Apple's been a winner for a very long time, so there's very difficult to go against it. Just as in the GE chart, it's been losing money for, hemorrhaging money for ages, now under $10. So you don't necessarily want to buy this based upon technical analysis. This is a sell-only stock. Now, eventually things do turn around. That can be through moving averages, which we'll talk about in the next video. Could be through a trend line, something to that effect. Hello and welcome to the second video of Module 1 in Technical Analysis Bootcamp by Wealthy Education. In this one, I'm taking a look at exponential moving averages. Now, quick explanation, what's a moving average? A moving average is simply a bunch of dots on a chart that are connected by a line, so that's really all you see, that measure the average of price. So, if we have a 15 moving average, what that does is it takes the input of the last 15 candlesticks, and 99.9% of the time, people use it for the close, but you can set it to the highs, the lows, whatever. And it puts a dot on the chart. So this is the average price of the last 15 candlesticks. And it shows that over time, if it's going higher, that means price is rising. It helps identify trends. Now, there's something known as an exponential moving average, and that's what I'll be using. An exponential moving average, if you can imagine the same 15 SMA, that's a simple moving average. It's averaged exactly how you would expect it. If you have 15 candlesticks, these candlesticks will have the most effect. The last 5 candlesticks will have the most effect on an exponential moving average, followed by these 5 and these 5. In other words, the most recent price action is weighted a little heavier. So let's add some moving averages. Click on indicators and you go to moving average exponential. And I'm going to put 5 on right now. And I'm going to come over here and you can see the show hide. So you can click that and they disappear. I'll go ahead and put this one back on. And I'll even thicken the line a little bit so it's easier to see. Now, this is the 9 exponential moving average. There are a lot of different ones that you can use, but you can see that it clearly follows price. It shows you that the trend is down, sideways, or up. So this should influence how you trade the market. So for example, John Deere 9-day exponential moving average was clearly going higher for quite some time, so it's a buy-only stock. most people will take this information and then look for technical patterns as well. A hammer, a gap higher, something like that, or support and resistance, as we talked about in this last video. That would have been a nice run there. Moving averages come in an infinite matter or level of possibilities. I mean, you can change this to whatever you want. So I'm going to go to the format, and I'm going to go to the inputs, and I'm going to talk about the 20-day EMA. Now, this is one that tends to be followed quite a bit, and you can see that it offered support for the market going higher for quite some time in a couple different legs, just as it's offered resistance, support, resistance, etc. Now, it's not the be-all, end-all, but it does have a bit of an influence. Even more important for the longer-term trade is going to be the 50. The 50-day moving average is one that a lot of traders will pay attention to, and you can see that it clearly is respected most of the time. But as I would point this out, and this is going to be true with all moving averages, as we move sideways, it shows the market isn't trending. As we drop, it's going lower, higher, etc. Another common one would be the 200-day, and a lot of times people look at this as a long-term average. And the reason for this specifically is 200 trading days in a year. So we were in an uptrend through about a couple of years here. Now we're kind of flattening out. You can see that this is what the market's done. It's consolidating. So when you see this, you may be looking at a range-bound trading system, and that's fine. It just shows you the environment that we're in. But in this time frame, it was clearly a buy-only market. There are a ton of moving average strategies, but one of the most common ones would be a crossover. So let's go ahead and format a quicker moving average. And I'll make this 50-day moving average red. And I'll show it. And you can see that it puts a thinner red line. And I can change that, of course, as I showed you earlier. Now, the idea is that when you cross, the short-term momentum, in this case 50 days, is starting to pick up. And then the 200 days starts to move right along with it. And you can see this just confirms that would have been a great buying opportunity. Now, what it won't do is keep you from getting whipsawed, but it keeps the losses somewhat minor. This can be modified with the idea of, what are the moving averages doing? Well, the 200 is still pretty flat. So some traders will wait till both start to turn up, and then they go higher. Now, this is called the golden cross, because typically if the 50 breaks over the 200 and they both start to turn to the upside, that means that you're entering a longer-term uptrend. You can see now we have broken below it, and that's technically a death cross, but you kind of need to see the 200 drop a bit here. As a side note, you can see that the latest candle printed was a shooting star right at the 200, and the 50 is starting to cross for another death cross. Now, death cross is very bearish. So let's switch to a market that I know is pretty bearish, General Electric. And you can see a perfect death cross, I'm sure. Yeah, right there. We drifted a little bit lower. The 200 started to drop, and then we really moved along. Now, traders will hang on to these trades until there's a cross. So they buy here, and they sell here. They sell here, and they buy wherever we turn around, which at this rate looks like we got some time to go. There are a seemingly infinite amount of combinations that you can use. So let's switch to, say, the 15-minute chart. The 200 won't carry the weight that it does on the daily chart because it doesn't represent anything. It's just 215-minute candles. It's not like a solid year. So a lot of times what people will do on these smaller time frames is they'll use like the 9, which is the red here, and then they'll use the like 20 or something like that. And then they'll just trade it the same way. You can see that we crossed and they buy and they just hang on until they short it. On a 15-minute chart, works out quite nicely. You can even do 5 minutes. Again, though, these numbers, truthfully, for the most part, are arbitrary. It really doesn't matter the numbers you use. Just keep in mind that the higher the time frame, the slower it is. So it's not that you couldn't use the 200. It's just that you would get a lot less signals. But then again, they should, in theory, be more reliable. So it really comes down to what it is you're looking for. But 200 5-minute candles. You can see that you broke down the 9, sloped quite nicely, dropped down, and it's kept you short for ages. So just something to think about. The direction of the moving average. The 200-day moving average is by far the most important one. The 50-day is pretty close, though. So you want to see a slope. You want to see a broadening, a spreading of these, because that means that in this case, the downward short-term momentum is really starting to pick up. You want to trade with the direction of the moving averages. If moving averages are flat, you don't want to be bothered using them, or some people just flat out won't trade the market at all. If the market just looks flat, see how this is flat in here, they won't really take it until both start to turn down, and that's a way to stay out of a range-bound market. Or it tells you it's time to trade back and forth in a sideways choppy manner, and you use a different system. You would use something like a MACD-based system or stochastics or something like that is built more for range-bound. So the moving average will keep you in the right trend. It'll tell you the state of the market, whether it's trending or not. Quite often it will offer support and resistance, although you can't always bank on that. Now 200-day tends to be much more reliable than many of the other ones, and that's probably due to algorithmic trading. Hello and welcome back to the Technical Analysis Bootcamp from Wealthy Education. In this video, taking a look at Bollinger Bands. Now, Bollinger Bands, if you remember your old math classes, there were the bell curve, the standard deviation, and 95% of action was within 2 standard deviations of the norm. So the idea is that price can get a little ahead of itself, a little lower overbought, oversold. That's essentially what you're using. The Bollinger Band indicator is a moving average in the middle. The 20 SMA, simple moving average, is the default for most platforms. So you'll have the moving average like you learned about in the last video. And then you'll have bands that form around it that show +2 standard deviations, -2 standard deviations. And keep in mind that this is the normal price, the trending average price. So let's click on indicators, click on Bollinger Bands, and you can see that we have a middle line here. This is your 20 SMA, you see 20, based upon the close, and then 2 standard deviations. So these lines, this is 2 standard deviations higher, 2 standard deviations lower. So when you look at a Bollinger Band, you should think of it as a couple indicators in one. So you have the moving average, you have the standard deviations, you also have the width of the standard deviations. So what I mean by that is in a more volatile market, they'll spread out because your average price swing and your average price for the day, in this case, is much higher. In a very kind of quiet, range-bound market that isn't doing much, you can see how thin it gets, and that shows you that the market just isn't very volatile at all. So you want to pay attention to that. Now, with all things technical analysis related, the first thing you want to notice is the trend. So when you have a slight lower or upper moving average, it's not a lot to do with the Bollinger Band. When you get a compression, then that tells you that you could get an explosive move rather soon. So let's go ahead and take a look at a couple runs here. We have broken higher. We've hit 2 standard deviations above the norm that is grinding higher with it. And you can see that we come back and we find support there. So the idea is that you can use the moving average as support. And you can see that if you just simply followed right along, you could have made quite a bit of money. But there does come this point here. So for example, this candlestick and this candlestick and this candlestick all catch my attention. And the reason is that they break out of the standard deviation band. And the one on the far left over here and this one are particularly interesting. And that tells me that perhaps it's time to exit a long position. This one tells me that we are starting to pull back. It's a shooting star. But when you close outside of 2 standard deviations, you are getting a bit stretched. So if you're long, this could be a reason to exit. Now, some people will short and try to aim for the other side. That's a bit riskier because you're not going with the overall trend. Another thing that you will sometimes see is some traders will actually look for a compression like this. And then once we explode to the upside, if you think about it, it makes sense that the first couple of candles do close outside of the standard deviation because we haven't been doing much lately. So what they'll do then is they'll just dynamically move their stop loss right along with the moving average to try to catch as much as the move as possible. Because clearly you had a breakout here just based upon support and resistance and then a close outside of it. So you could have gotten long here and gotten out here for a nice multi-week gain because this is a daily chart that I'm looking at. The moving average starts to roll over. We close below. You could look to short next time we touch it. And you can see that it just kind of rinses and repeats just time and time again. An explosive move to the upside formed a shooting star, but we broke above the shooting star, which is a very bullish sign. And you could see that that was probably a break even trade if you did the stop loss at the moving average thing. But you also had a shooting star close just outside of it, which, as I mentioned earlier, is a sign that perhaps we're getting ready to pull back. So you could have gotten in here, got out here, or here, just kind of depending on how you played that. Bollinger Bands, for myself, I found them to be extraordinarily useful for determining when a stock may move violently because of the compression. That's my favorite use for them. But there are a multitude of ways to play this. So just by all means, do stick with the trend, though. This is slightly bearish trend, so you could make a little bit of money selling. But then again, when you look at the longer term attitude of the market, you would have expected support there. So it's a tool. It's not, unfortunately, some people use Bollinger Bands as a complete trading system. And I think that's somewhat dangerous. You never really want to use just one thing. Price action, support, and resistance are the bedrock. And then you can add this on top of it. So for an example, let's go ahead and draw a horizontal line here at this previous resistance. So you would have known that somewhere around $32-ish there was resistance. And you would have also known that there was support here. So it makes sense that there's going to be a lot of buying pressure in this area. And that's exactly what we saw. So where's your signal? Well, your signal could be every time you break above this moving average. But quite frankly, I think the most interesting candlestick is the shooting star that formed here at a place where you would expect to see selling, and then it gets busted through the next day. If you don't like that, a return to the moving average, you would have had to wait a couple of weeks, but you got a nice opportunity there. At that point in time, you had multiple trades that would have worked out. Bollinger Bands are good, but you have to use them as a tool, not an entire system. Hello and welcome back to Technical Analysis Bootcamp by Wealthy Education. In this video, I'll take a look at the MACD, the Moving Average Convergence Divergence Indicator. Now, the MACD is found in the indicators list right here. I click on that and it's compiling it. You can see that it brings it down and it forms a histogram in the center and a couple of moving averages. Now, really what the MACD does is it shows a couple different things. It shows a moving average. The 12 and the 26 typically is what is used. It shows based upon the close in this case. That's standard. And then, go ahead and go to the format. Signal smoothing, 9. So what that means is basically the histogram shows how much the moving averages are diverging. Now, there are as many ways to trade the MACD as you can imagine, but I'm going to go through a couple of the most common ones. Now, some people will use just the histogram, and what they'll do is if it's strong, they'll be buyers. If it breaks down below the 0 line, because you can see that there's 0 there, they're sellers, and sometimes they'll just buy and sell based upon that. It's a very poor methodology of trading in the long term. I don't even know if it works. Maybe. But what people a lot of times will do is they'll look for divergence. So, for example, if price is going higher, like it is here, but the histogram is going lower, that shows that the momentum between the moving averages are slowing down, and perhaps we're running out of strength. At that point, they start to look for selling opportunities. It works the other way as well. You know, the histogram going, or the prices going lower, histogram rising, that happens. And that's divergence. So that's probably one of the most common ways. And you just completely ignore the crossovers or the moving averages. Crossing over is another thing that people will pay attention to. You can see we got a moving average crossover here. That would be a sell signal. And this would be a buy signal, just like a moving average crossover system. So sell to this area. Furthermore, people will use just a signal line crossover of the moving averages, meaning that they would have bought right around here once they both crossed and looked for a reason to get in or out. The problem with using just the signal crossing, you can see that's a break-even trade, and there is no reason to give up $13 on Alcoa daily chart for that. So signal line crossovers are typically used in congruence with something else. Probably the only system I know of using MACD by itself that people have any success with is the crossover. Not the 0 line crossover, but the moving average crossover. But really, if you're going to do that, then you might as well just plot the 12 and the 26 up on the chart. So it kind of makes it redundant. That being the case, you can make a strong argument for using the MACD with other methodologies. And my favorite, as you should know by now, or the most important, is support and resistance. So let's go ahead and draw some lines and see how this plays out here. Okay, these are some, let's see, one more here, I see. So this is some really basic support and resistance lines. They're not queued up to 45 exactly or anything like that, but this will demonstrate what we're talking about. So at this point, this is an area that's been resistance and we've pulled back and we have that crossover down here. So that's another reason to think we're going to hold. We banged into resistance up here. If you go back far enough, it probably shows resistance there at a crossover. But that's also something to pay attention to down the road because we have a crossover right here as we gapped below that area. And it was a sell signal. You know, when did we get chance at a crossover? Right here where we started to bounce a little bit. So I actually like using the crossover, but I am fully aware of when we get divergence, like I moved or pointed out previously, because divergence can be a powerful signal to either exit a trade that's gone very well, or perhaps look for a shorting opportunity. which you got based upon this crossover and this gap lower. So it's a nice little tool, but it's a secondary tool. And I will pound this into your head throughout this course. Support and resistance and trend are your primary indicators. Then you get potential candlestick patterns, which is module 2 in this course. And then, of course, these indicators. I want you to understand that the more reasons you have to take a trade, the better off you are. So, for example, this crossover here, if you were already long based upon this previous resistance becoming support and the MACD crossing, well, this crossover here might not be a sell signal. It might be a signal to take profits. See, it just comes down to how you choose to use it. You don't necessarily need to short the market against the trend. But it does show you that, hey, maybe we've gotten a little farther ahead of ourselves than we need to. Take the profits, get out. That's a nice $15 gain. It's a perfect example of how this can be married to support and resistance and the like. Hello and welcome back to Technical Analysis Bootcamp by Wealthy Education. In this video, I'm taking a look at the RSI, the Relative Strength Index. It's an oscillator, and it helps you identify overbought and oversold conditions. So let me go ahead and pull this up, click on Indicators, and then, of course, RSI. There's RSI Strategy. That is not what you want. You want Relative Strength Index, so be aware of that. And what this does is it brings into the idea of perhaps overbought and oversold conditions. So there's a range between 70 and 30 that is considered normal markets. Eventually, you break above 70 and then you become overbought, or below 30 and you become oversold. So let's go ahead and choke up on the time frame here a bit and see how things pan out here on Sprint. Okay, so here's an obvious overbought area. High volume. You can see that we did pull back a little bit right back into normalcy until we got into oversold. So what do? Well, in this case, it's obvious that there was a huge move up on massive volume right after earnings. We've pulled back. We found an oversold condition, formed a hammer right here on the hourly chart. It's time to start buying. We got overbought right here. That doesn't mean you sell necessarily. It just says that we may pull back, and that's exactly what we've seen. We got oversold there. The market went higher again. Let's go ahead and take a look at JP Morgan. And you can see I've got the hourly chart here, and you can see that these overbought conditions warned of a potential breakdown. That's exactly what happened. We were at resistance anyways, so that just confirms that you should be taking profit if you're long already. Or there could be a short-term scalp to the downside. Now we got oversold right here. Makes sense. It's right at support. Bounced a bit, but never got into the overbought condition, and then eventually broke down to oversold, had a nice bounce right to 110. Well, lo and behold, there's support there. Turned around and broke down again. So going out to the daily chart, you can see that we got into an oversold condition here at the end of a huge run. Now, I'll point out here that there are several oversold areas on this chart as far as the RSI is concerned, but you could also make a extreme argument for a nice trend line there. So really, why are you trying to sell? It's just telling you that a pullback may be imminent. We didn't get much in the way of oversold conditions. We did touch these areas, but we didn't close below it. So, I mean, you could have just used the trend line. But right here was, I suppose, a candidate to start thinking about buying. So in a lot of ways, the RSI is probably better for re-entry of a trend, or perhaps taking profits, or just a heads up to let you know that, maybe perhaps a pullback is necessary. Recently on this chart, you can see that we pulled back right to an area that should be supportive and did break the threshold of oversold and bounced quite nicely right back up to resistance. So you can see time and time again, it works really good with support and resistance. It works really good at entering trades on a pullback, or giving you a heads up as to when you may want to take a profit, depending on how quick you're looking to ring the cash register, as it were. The RSI is a very useful indicator, but it's not necessarily something that you want to just say, okay, well, it's time to start selling because it's popped above here. Or it's time to start buying. You want it to line up with other factors on the chart, such as support and resistance. That's the last video of Module 1. In the next module, we'll start to look at chart patterns, candlestick patterns that you can use in congruence with these and really kind of push your trading to the next level. Hello and welcome back to Technical Analysis Bootcamp Buying Wealthy Education. In this video, the first one for Chart Pattern Trading Mastery, Module 2 of the course, we're going to take a look at a reversal pattern called a double top, and we're also going to look at a double bottom. Now, it's exactly what you think it is. It's market tops out, it tries to again, and then eventually it fails. And this is a negative sign because it shows where the market won't go. And that's one of the things that you need to be aware of is sometimes, everybody wants to know where the market is going to go, but sometimes you have to reverse engineer it. You have to figure out where it's not going to go. That's just as crucial information. A double bottom is just simply the same thing. It's a place where price won't break through to the downside. It's also called M pattern and W pattern for obvious reasons. And beyond that, there's also triple patterns. So like a triple bottom, which is even more stringent, or a triple top. These are a little bit more rare, though, but clearly you should take notice when you see them. So here on AT&T's daily chart, you can see that we have a double top. So how do you trade this? Well, one way to do it, and probably the most common way, is to look for the pattern itself. And you recognize that this is an area here, let's say $42, that has offered support with 42 or 44 above offering resistance. Well, on a breakdown, you simply are looking to put your stop loss above the top so that it's no longer a double top if it gets broken to the upside. And you just extrapolate down to the next support level, or at least the same size. Now, as far as risk, size, and as far as trade size, risk to reward ratios are concerned, you want something a little bit more healthy, if you will. So let's go ahead and say you short here. If you get halfway through this pattern, there's a good chance you're going to go back to the top. So if you take this pattern, that's $2 tall from the support level and the double top, you should aim for at least the same. So by its very definition, you're risking $1 for 2, and that's a good risk to reward ratio. A double bottom works very much the same way, and just because it's a bottom in its name doesn't mean that it has to be counter trend. So, for example, we've rallied quite nicely. We found support here and here. That's a double bottom. There's a nice hammer there. So you would be more apt to get in earlier in this scenario because it goes with the overall trend. It's supportive. A hammer is a bullish candlestick. Once you break above this double top, ironically enough, you extrapolate for at least the same size move, if not further. With the trend, I tend to let it run a little further. Once you break out of this area, you'd put a stop loss in the middle of it, just as you did in the initial trade. But you wait until you break out, so you actually got in down here, so you get a little bit more in the way of profit. Here's an area that was, it's kind of like a triple bottom. Again, though, they're pretty rare. They're difficult to find. These are daily charts. But if you zoom out enough, one thing that you'll notice is that a triple bottom, double top, whatever you're talking about, it won't necessarily always be exact. There might be a few cents between the top of the candles. This is just simply a sign that the market doesn't want, or is struggling at least, to go below, like right here at the $32 level. Now, I would point out that we had actually broken below the $32 level at one point, down to about $31.77. But this double bottom shows that there is a lot of buying interest here, and you can see exactly how that played out longer term. These happen, of course, on short-term charts as well. I'll take it down to 15 minutes. I'm sure we'll see plenty on the chart. Right there is one. There's a very bearish candlestick there, so that would have been your first hint that this was a double bottom, or double top, excuse me. You can see that we had a range like this, so you would want to be aiming for about the same. That's exactly what you got almost immediately. Little bit of a double bottom here at an area that had been supportive in the past. You might even be able to stretch this out to say it's a triple bottom. I think that's probably using a little bit in the way of artistic license, but you get the idea. Double bottom here worked out quite nicely. Lots of volume. That helps. And keep in mind that volume shows real conviction. So that's what you want to see as well. These are patterns that repeat themselves time and time again. Here's a double bottom here. Nice volume in this area. Not quite a triple bottom, but same idea. And you can see we have been rising since. So keep an eye on these patterns. Notice that price won't go somewhere. And then it's pretty good to bet against that, either using a short position in a double top, or a long position, a double bottom, or even selling options if you do options above that double top or below that double bottom. Hello and welcome back to Technical Analysis Bootcamp by Wealthy Education. In this video, I'll take a look at rounding tops and bottoms. So a rounding top or a rounding bottom is simply market action that looks like these two lines here. It's just a simple and gradual decline of buying pressure or selling pressure. It's a market that is turning around, albeit in slow motion. Now, the higher the time frame, the more important it is, obviously, but it does happen on shorter time frames. A rounding top can be measured. You kind of have to use a little bit of imagination, but you can see where it starts to round higher, where it would break lower. And then you take the distance. So let's say this is $1 here. And on the break, you're aiming for $1 lower. The same thing over here on the rounding bottom, where we started to arc away from, or started to decelerate the downtrend, turn around and rally again. Once a break above that, you aim on a breakout for the same distance here. So if it's $3 from the bottom to these levels, then you're aiming for $3, just as the top to the breakout point and the beginning point is $1 over here. With that being said, let's take a look at a couple of examples. And here I have Boeing on the hourly chart. You can see we just kind of rounded out here. We broke down below here. This was a $5 move waiting to happen. And clearly you got that almost immediately and by the end of the day. This is just momentum dying out in an uptrend. It shows that the market can't hang on. So over here in Hyatt Hotels, a little bit more extreme, you can see that we rallied quite nicely and then just kind of rolled over in this bottoming pattern. We broke higher and we did match the top. The top of the move here was the match for this distance, about $3. So you can see that it's not necessarily the most obvious pattern. It's a gradual pattern. And that's part of what, as opposed to this is a sudden reversal. That's part of what makes it so interesting, because it's the market slowly gathering information over time and changing in its directions. Rounding tops, rounding bottoms, very good patterns. Although it is not the type of pattern you expect an explosive move from. It's more of something you're just thinking of. Think of it this way: going into a river and just joining the current and letting it take you higher or lower, depending on which one you're involved in. Hello and welcome back to Technical Analysis Bootcamp by Wealthy Education. In this video, I'm taking a look at broadening tops, broadening bottoms. So, a broadening top or bottom is basically just the market doing this, where we're just getting more and more volatile. And you can draw, for example, you can draw trend lines like that. Sometimes it's called the megaphone pattern. It's much more common on the top than the bottom. And what happens is, so for example, in a broadening top or a rallying, and then markets just kind of, they start to make a lot of noise. It's a sign of confusion. And once you break down through that support level there, this trend line, it is a capitulation by the bullish traders and we break down. Now, obviously, a broadening bottom, same exact thing in the other direction. It just shows that the market gets confused and then suddenly changes the overall direction, because trend changes are a messy thing in general. So on this chart, I've got the United States oil fund. It's basically, and it's an ETF that you can use to trade crude oil. It's an easier way to do it than going into the futures markets. And you can see there's a couple of trend lines here. So what happened is we rallied quite significantly. About $6, and then the market just couldn't hang on. And you can see that we took out most of the gains all the way back down to where this started in the first place. And you'll see these occasionally. They aren't necessarily extremely common, but they do show up in times of uncertainty. And your job as a trader is to look for uncertainty and then react once certainty comes back into play. So the problem with these broadening tops and bottoms is you need to be cautious not to start drawing them everywhere, because they're very easy to draw everywhere. You can see that I've already adjusted this, and technically it's a broadening bottom. As a rule, I'd like to see at least 3 times on each trend line. We broke above a false breakout and then we continued. So once you break above and you pull back in, that's more or less a false breakout. So it kind of negates the pattern, but it tells you the same thing. So another thing that you may want to think about this in terms of is that, like in this case, the highs continue to rally, and that is a trend change in and of itself. Now remember, trend changes are very volatile, because what happens is all of the people that bought down here and along the way, they all kind of have to be taken out. So they're fighting, and then finally they give way. Now, with this pattern, you can see that it was a nice pullback. Probably one of the more difficult patterns to trade, only because it can be so sloppy. But once you break through those lines, it gives you a good directionality to try to time a trend change. And trend changes are one of the more difficult things to do in trading. It doesn't really matter. The instrument can be stocks, currencies, whatever. So with that in mind, keep an eye on these potential megaphone patterns, if you will. They are much more common to the upside than the down. I suspect that's probably due to the proclivity of most markets to try to go higher. And therefore you just have more opportunity for trend changes like that. But that being said, it's just the way the markets kind of freak out for a while and then suddenly reverse, as we saw. We just kind of think we're at the top of a roller coaster. Or we're getting towards the top of a roller coaster, and the momentum slows and slows and slows and then just falls. That's essentially what you're looking at here. Hello and welcome back to Wealthy Education's Technical Analysis Bootcamp. In this video, I'll be taking a look at the bump and run top and bottom reversal pattern. So a bump and run, take a look at a top here, is simply a trend line, a nice trend that's going along, and then you start to accelerate. So there's a phase called the lead-in, which is, what most traders want to see. You just want to buy the dips, continue to hold, whatever. And then you get the bump, meaning you bump up in volatility as well as aggression. And then you break down to the original trend line. And once you break this original trend line, this is a very negative turn of events. Typically, you're looking for a return to the bottom. Doesn't always happen, but that's the longer term outlook. This is something that should be traded on higher time frames in general because it leads to a trend, like a real trend. Now, in a bump and run bottom, it's just the same, but opposite. So you're kind of gradually moving along. You might be in a nice little channel here, and then you break down. It gets really aggressive, and then you eventually break through that channel. Extraordinarily bullish sign. So one of the best ways on TradingView to kind of get this, give you a nice graphical representation, is to click on the trend angle tool on the line tool. So you can see that, here we have a 19-degree trend line, been hit 3 or 4 times, and then all of a sudden you see a surge higher, which is 55 degrees. So generally, most technical analysis related traders don't like a trend line above 45, 50 degrees for a longer term move because they typically aren't sustainable. Well, here on eBay, you can see that we had a nice run for quite some time. Things got especially aggressive. Then we broke down. You can see this massive surge in volume on a retest. So not only did we break through the trend line, but we've come back to form a bit of a shooting star, a massive gap lower, and we have, in fact, wiped out the entirety of the move. Now, on a 15-minute chart, this may not mean much, but on a daily chart, this is a huge move. So keep that in mind. Over here in the Royal Bank of Canada, we have the exact opposite. So go ahead and do the trend line, or the trend angle, I should say. And you can see, it's losing 22%. 22 degrees. That's sustainable. It's not a massive, ridiculous angle. But this happens at 74. And at this point, it's oversold. So a bounce makes a lot of sense. But once you break above here, that really tells you that the initial push is starting to break down now. And you've wiped out this move. Very bullish. The entry is just above this trend line. The stop loss is kind of discretionary, but I would say maybe 2% of a breakdown at that point, you probably want to get out. It'd be a false breakout. But clearly with this nice bullish green bar breaking above the top of the shooting star, that's a couple of other reasons to think that perhaps we're going to go higher. Hello and welcome back to Technical Analysis Bootcamp with Wealthy Education. In this video, I'm going to take a look at diamond tops and bottoms. Now, these formations basically, and they don't have to be a perfect diamond. I just happen to be drawing one. They can look more like this. What happens is you get a run, and this is a top, obviously. This might be the bottom, diamond bottom. You get a run higher in the market, and then you start to form a couple of, it's like a broadening formation that we talked about a couple videos ago, but then starts to tighten back up. And then once you break down, what this tells you is that there's been a lot of soul searching in the market, so to speak. And suddenly there's bearish pressure that people are willing to really get involved in. And everybody in this diamond is trapped. So the market needs to break down. They need to cover their positions. In a downtrend, you can see the exact same thing, but then an explosive move up. And that, of course, is a diamond bottom. Now, there's no real measuring stick in these. A lot of people will try to aim for the height. That typically works out, but there isn't like a bona fide measuring stick, if you will, like you have with some other type of patterns that we'll be going through in this module. So let's take a look at what this looks like. I'll go ahead and pull up the trend line tool, and you can see that we have seen a lot of noise in this area, and I can draw trend lines like this, like so, to form the pattern itself. And, we're in a nice uptrend, and then we start to lose a little bit of confidence, and then we finally break back down. You can see that we test the midpoint of the triangle and then the diamond, and then break down from there as well. So the question is, what would you have aimed for? Well, this is about $8. So $8 from 73, that's got you right around 65-ish. And that's where you do end up. And now you've gapped lower and you're starting to see more resistance. So clearly that is a viable signal. Now here in Teva Pharmaceuticals, we have a bottom. And it's, kind of a sloppy, and some of these will be. You'll see this occasionally. I'll go ahead and extend this out just a little bit more. And there you go. It's a diamond bottom. And what's happened is we've sold off, and then there's just a lot of indecision, and then we broke higher. Now, something that I'll point out here, not to make this more complicated than it needs to be, because we got basically our height. But another thing, and you'll see this a lot as you go along, and this makes these type of signals even more important. Notice that we have higher lows going into the exiting as well. We continued the downtrend. That shows that there is still a bit of conviction. But the next time we make this higher low, then all of a sudden you've got people kind of wondering whether or not we can hang on. So a lot of that comes to short covering, and eventually we break out to the upside. Diamond patterns and tops and bottoms are a little bit more difficult to trade than some of the other patterns. The main takeaway here is you need to keep in mind that it's a loss of confidence in the overall trend. Hello and welcome back to Technical Analysis Bootcamp by Wealthy Education. In this video, we're going to take a look at Head and Shoulders. Now, Head and Shoulders, there's a bullish and a bearish pattern. And simply all it is the market rallies, and this is the standard Head and Shoulders, and it impulses, and it rallies, and then it drops. Now, the inverse, of course, is the exact opposite. Now, what does this mean? Well, if you're in an uptrend, in this case, or a downtrend in this case, you need to think about what's going on here. The buyers push the market higher. We pull back a little bit. Then we turn around to rally even further, which, if you're in an uptrend, that's all good and well. That's exactly what you expect. However, when we pull back the third time, we don't make it quite as high. So what does that mean? Well, it means a couple of different things. It means we're running out of momentum and follow through. And at the very least, at this point, everybody above here is now losing money. As we continue to drop even further, more and more people are losing money, and that has people having to close out their positions. Conversely, in a downtrend, you can see that we have fallen. We've rallied, which you expect to pull back occasionally. We've fallen even further. So far, so good. And then the next time we fall, we don't do so as much. And again, we have people underwater. We have people trapped in a bad position. Market's gone against them. All of these people are losing money. Now, what I love about the Head and Shoulders pattern is, number one, it's pretty easy to see. It's widely traded, and of course, it has one of my favorite aspects about it, and that's the neckline. And the neckline is simply where the two lows meet in the middle. Once we break the neckline, you then either sell in Head and Shoulders or buy in an inverse Head and Shoulders because it is a reversal pattern. The target is built in from the neckline to the top of the head. See, there's a head and there's two shoulders, or the bottom of the head in an inverse pattern. So if that's $10, you're aiming for $10 from the breakout point, from the neckline. So let's see some of this in action. One thing that I should point out right away is that Head and Shoulders patterns don't necessarily have to be directly sideways. So they can be like this, and then the neckline just goes like that. And that's what I'm showing you right here. You can see that we rallied again, and then we failed here. So where's our neckline? Our neckline is right there. You can see how that plays out. The distance from the top part, 42, down to 38, measures for a $4 move. A breakdown from 39 suggests that we're going to at least 35, and you can see that we not only did that, we did more. And sometimes you'll find that's the case. But that's a pretty straightforward trade. Where do we put our stop loss? We put our stop loss right above the final shoulder. Because if that breaks to the upside, then it negates the entire pattern. As I mentioned, there are inverse Head and Shoulders. And this is a bit of a continuation Head and Shoulders, if you will, in the sense that it was a pullback on a counter trend move. We've come back. We've bounced from here. You can see that we clearly got our designated move and continued to go higher. The thing that you need to pay attention to the most is that it's a trend that is running out of momentum, and there's everybody above the neckline is trapped, or below the neckline if it is an inverse Head and Shoulders. They have to reverse their positions, adding more pressure in whichever direction, continuing the momentum. Head and Shoulders patterns are great. They matter more on larger time frames, as all things in technical analysis do, but they can be used on any time frame. Hello and welcome back to Technical Analysis Bootcamp with Wealthy Education. In this video, we're talking about wedges and triangles. So when you have a couple of support resistance lines that are not just horizontal lines, although they can be in the patterns, something like this, or even this, you have a triangle. Triangles need to be completed and broken out of within the first 80% as a general rule. Stock markets will do, and this is true for all markets, will do this and then eventually break down. That is a descending triangle. And the reason it's a descending triangle and the reason it's bearish is because the sellers are becoming more aggressive. They're selling at lower levels. They're pushing and pushing and pushing. And then finally you break through the support and the market can continue to the downside. An ascending triangle is very similar. Same reasoning. The buyers are becoming more aggressive. This resistance is holding true, but once it gives way, the buyers get their way and we go higher. The symmetrical triangle is more or less neutral. It's just the market compressing, and then eventually we decide to go one direction or the other. They're all very common patterns. They're all patterns that people pay a lot of attention to, and they work in various time frames. It didn't really matter. So think of it this way. The sellers are becoming more aggressive. There are buyers here trying to support the market. Once they lose, the market drops. If we drift through the edge of the triangle, then it negates the pattern. Wedges come in two varieties. There is a rising wedge and a descending wedge. And a rising wedge is a bearish pattern because on the breakdown, it shows that we just could not continue to build up momentum. A falling wedge is bullish. Now, all of these come with a measuring stick. The height of the triangle, regardless of which direction, is your target. So if it's $1 from the top of the triangle to the support level, on the breakdown from this level, you're looking to see the market fall $1. If it is $1 here in the symmetrical, same thing. From the breakout or breakdown, you're looking for $1. And of course, the ascending, same situation. With the triangle, a lot of times you can put a stop loss either on the other side of the triangle or in the middle if you're a little bit more cautious. A rising wedge is just simply the market giving back on the breakdown what little bit of momentum it kept. You're looking to aim towards the bottom of the pattern. In a falling wedge, you're looking to aim towards the top on a breakout. Stop losses can be placed on the other side of the wedge or even the candle that sends the market higher or lower, depending on which variety you're talking about. So let's take a look at a couple of examples. This is a rising wedge. Now, the first thing that you will probably notice is that we do have a couple of wicks outside of it. This comes down to the individual trader, but for myself, when I see a clear trend line like that, I recognize that there's a lot of selling pressure there. So that would be my first hint that perhaps there's a little bit of trouble. On a breakdown below this, we got a quick move right to the bottom of the wedge, stop loss on the other side of the candle. Could have been a very nice short-term trade. Obviously, it went further, and quite often that's the case, that you will see the market not only reach the target, but continue to go further. But as far as the pattern is concerned, that's the initial target. Over here, we have a scenario where we have support, and we also have a bit of a trend line. We break down below the bottom of it. It's 20 cents from top to bottom. You extrapolate that from here, from 990, and you get a move to 970, and that becomes even more interesting because of the gap here. So you would have expected that to be supportive. So that move makes a lot of sense. Now, as we go through the charts, and here's an interesting one. Remember when I told you that sometimes the triangles don't fire off in time, they just kind of drift. And you can see this ascending triangle, which should have been a bullish move, just kind of drifted sideways, and we continue to roll over. Here's a descending triangle that did kick off in time, and you can see that we definitely got our move just on the gap alone. There are failed triangles, which of course happen from time to time. But you'll notice they don't tend to happen after firing to the upside or downside if that's what you're looking for. So like an ascending triangle, this is a failed descending triangle, or ascending triangle, excuse me. You can see that we never really kicked off and we just kind of rolled over. But watch this. You can also make an argument for a rising wedge because it's not perfectly level there. So a lot of times that's what happens. You see it doesn't quite line up perfectly for a triangle and ends up being a wedge. And, we obviously got that move plus quite a bit more. Like with everything else, technical analysis related, you want the higher time frames to coincide with what you're looking at. So for Ford, let's go ahead and zoom out to the daily chart. So you have a stock that's obviously bearish over the longer term. So any triangles that you want to take, hopefully you can find descending triangles, which of course are going to be negative, to trade. So with that in mind, over this last, we'll say 5-ish months, almost 5 months, you line up the chart with what's going on in the daily, and we're back to like this descending triangle was an excellent trade signal. You have the building measuring stick, but if it's with the overall trend, you may choose to hang on to the short trade even further. But clearly that's been the way to go for some time, downtrending. Here is a triangle that kicked off pretty quickly. And you can see, obviously, we got that move, got more than that, and continue to go much lower. So triangles are a great way to look at the market in the aspect of, momentum. Is momentum holding up? Does it break? If it breaks, then what does that mean in the overall trend? You can make a serious case for a failed ascending triangle here, which I said quite often ends up being a wedge, and it kind of is there. And that's probably the reason why people don't trade wedges as quickly, because they're a little bit more artistically creative. A triangle's pretty straightforward, and that's the beauty of the triangle, because so many people recognize it, that you have a lot of traders out there using it. That being the case, again, I encourage you to go with the longer term daily trend, perhaps using an hourly chart, as to fine tune your entry. And then you can trade these triangles. They do tend to be very reliable. Again, the wedge is a little less reliable, but certainly viable patterns, especially in a situation like this where we're in a downtrend longer term. You can make an argument for a little bit of a rising wedge there. The breakdown below it's bearish anyways. It goes with the longer trend. So it gives you reason to believe that you are going to continue to go lower. Hello and welcome back to Technical Analysis Bootcamp from Wealthy Education. In this video, rectangle tops and bottoms. So a rectangle is simply support and resistance that's relatively even, parallel if you will. Markets go back and forth, forming a rectangle over time. Pretty easy to trade. A break down or up should get a measured move of the triangle. So if this is X, you're aiming for X, $5, whatever it is, in either direction. And that's how you trade consolidation. So a rectangle top or bottom is traded the same way. It's just at the top of a trend or the bottom. It's a reversal using a rectangle as its conduit, if you will. So I'm going to go ahead and draw a horizontal line for the top and the bottom of this rectangle up here. And as you can see, the area here has been support and resistance. And it's roughly about $7-ish and Boeing. It's at the top of a big move, and we have certainly broken support here at about 367 or so. So that puts us right around 360. And that's exactly where we go to initially. It's a counter trend move, but it certainly was a viable move. The alternative is a rectangle bottom. And I'll go ahead and draw out the horizontal lines here in Goldman Sachs. And you can see that there's about $5 here. And I'll frame it out here with my drawing tool so that you can see exactly what I'm looking at. Maybe even a little bit more. May have made it a little too small. Maybe $6. $5, $6, somewhere in that neighborhood. You can see that we've clearly broken above the top of the rectangle here. We've tested a little bit and certainly shot up quite a bit in value from there. Pretty straightforward how to trade these things. What I do like about these is that it really doesn't matter if somebody is trying to trade a rectangle top or bottom. It's a basic consolidation pattern. And in fact, top or bottom is irrelevant, because you trade it the same way regardless. It doesn't matter if it happens in the middle. It's just this is a way of identifying a major turning point. If you have a rectangle and you have the market bouncing around in it, let's just say this is a rectangle bottom and it takes off. let's say this is $20, so we know that we aim for the height of the consolidation pattern. You put a stop loss right in the middle. So what does this do? This guarantees that you're risking 1 unit for every 2 that you're aiming for. Also, if you get a bit of a false breakout, it'll take you out quicker than having to wait until the bottom of the pattern. These are great patterns. There are people who make entire careers out of trading breakouts of rectangles. I encourage you to definitely look on the charts. Higher time frames matter, of course, much more than a 5-minute chart, but they work all across the board. Hello and welcome back to Technical Analysis Bootcamp by Wealthy Education. In this video, I'm going to take a look at the flag and the pennant. Now, a flag and a pennant, they're just simply a continuation pattern of consolidation, a pause in the up or down trend, if you will, because there is the bullish and bearish varieties of both. A flag is basically drawn out like this or like this. And what we have here is an uptrend, and in this case a downtrend, and an inverse or bearish flag. And price will rise for a while, and then it'll enter a consolidation phase where it pulls back ever so slightly in a channel. Eventually you break the top of that channel and you continue. The great thing about a flag is that it has a measuring stick, the pole. So on a break, say this run higher is $5. On a break above the top of the flag, the slightly descending channel, you're looking for $5. Now, the same thing in a bearish, say we're going down 3, we kind of bounce back, the market kind of calms down and then gets another surge lower. You're looking for 3 at that point. So those are flags, and you can see it's a pole and a flag, and you can see why they call it that. There is such thing as a pennant, and a pennant is very similar. You get the bullish and the bearish version, and then you get more of a triangle. Same idea, same measuring stick, the pole of the pennant. So in this case, if this is $3, and then price kind of comes up and consolidates in a triangle, takes off, you're looking for 3. Over here, if it's $2, on a breakdown, you're looking for 2 from the breakdown itself. So with that in mind, let's take a look at a couple of examples. Now, I happen to have a couple of bullish examples for you, but quite frankly, they appear in both flavors in just as much frequency as the other. And actually, looking at this, I actually have a bearish example for you on this chart. The bullish example go ahead and use this line tool here. A flag can be seen here. From 330 to 345, we rallied, and then we pulled back in Boeing. And then once we broke out, you're looking for the $15 to be taken. So from about 333, you're looking for 348, which we clearly got. Matter of fact, we even got it on the gap the next day and went further. Again, sometimes that happens. Now, as I look at this chart, I can also make an argument for a bearish pennant, because unlike a flag, a pennant doesn't have to be a specific shape other than triangulation. So this is, and for those of you who are a little bit more astute or have been practicing, you also will notice that this is a bit of a descending triangle after a run. So there's a couple different signals there. You're looking for a move of 360 to see 345, so that's $15 or so on the breakdown, and that's pretty much exactly what you got before you turned around and made the flag pattern here. So pretty good example there. And over here in Under Armour, we're going to take a look at a small bullish pennant. You can see that there's a bit of a symmetrical triangle there on top of this measuring stick. from right around 1775 to 1850. So it's 75 cents we're looking for. So that's 1925. And you do, in fact, get it, and you pull back again and you continue. These are easy patterns to deal with. Everybody pays attention to them. That might be why they're so reliable. As a rule on the pennant, though, the one little caveat I would put is that pennants, think of them like triangles. So you want to see them break by the time we get to 80%. Otherwise, then it just becomes a messy pattern. Flags are a little bit more forgiving. Flags are definitely probably more followed because you can, with a little bit of creativity, make a pennant out of a lot of different things that may or may not be reliable. Remember, though, the measuring stick, the consolidation, take that measuring stick, extrapolate it out from the breakout, and aim appropriately. Hello and welcome back to Technical Analysis Bootcamp from Wealthy Education. In this video, we're going to take a look at cup and handle. Cup and handle is a bullish pattern. There is some debate as to whether or not it has an inverse, but is not commonly followed as an inverse pattern, so we will stick with the standard pattern. A cup and handle is simply one that has a market that does this, kind of like a rounded bottom that we talked about earlier. But it pulls back a little bit before taking off. Now, the first thing that you'll think of is, well, isn't this basically a flag? And it kind of is. So it's like a rounded bottom and a flag. It's called a cup with handle because it's supposed to be, it's thought of as like a teacup, if you will. And then you go higher. It's a pretty straightforward pattern. The great thing about cup with handle is that it has the measuring stick built in, the top to the bottom. On a breakout of the handle, you go higher. Now, I keep drawing the handle this way on purpose because you rise and then you consolidate a little bit before taking off. That gets rid of that last little bit of resistance. Higher time frames typically find these patterns. You don't see them as much on like a 15-minute pattern as you would like a daily pattern. On this chart of Boeing, I have an example of a cup with handle. You can see that that would be the top of the cup. You can also see that we have a little bit of, it's almost like a flag. It's not a straight pole though. And it trades very much like that. So once we break out of it, we break above this area here, then you're looking for a move that matches the height of the cup, which is $10. So basically from 135, you're looking to hit 145, and you do pretty much right away. You pull back and then you continue going higher. That's not a huge surprise. Now, there is an inverse version of this that some people will trade. It simply is the exact opposite. However, I have found those much less reliable. So those are not normally one that I pay too much attention to. You can see that it is somewhat subjective because the same trader could say, well, it's basically just a rounded bottom. Or, it's a bit of a flag, kind of. And that's essentially what you're looking at here. Remember them both. Remember, you're trading for the same height of the pattern. I would also point out that with the handle part here and the rise, when you break out, you want to put your stop loss at the bottom of the handle. Now, in this particular case, that's a $4 stop loss for a $10 gain. And those are the type of trades that you'll be looking at. And truthfully, this was a major breakout of resistance anyways. So you can see the market just took off from there. You really could have gotten $30, $40 on this one over the course of the next several months. Cup and handle pattern, like I said, a little less common, means a lot more on the higher time frames. Shows a gradual reversal of the bearish pressure, a little bit of consolidation, and then taking off. This is the last video in Module 2. In the next module, we'll start to look at the 1, 2, and 3 candlestick patterns. From Wealthy Education, this is our Technical Analysis Bootcamp. This is Module 3, Candlestick Pattern Trading Mastery. In this video, we're going to take a look at 2 candlesticks. One is a doji. Another is a spinning top. And as I draw these out, you're probably going to say, this looks very similar. And the answer, of course, is, well, they are. It shows indecision. A doji means simply that the open and the close is basically the same. There are different types of dojis. There are various names, like this is the dragonfly. This is the gravestone. There's daddy long legs. I mean, there's just a ton of them. Now, the dojis that have a lack of a wick above or below, so for example, the gravestone or the dragonfly, in this case, that's a bullish doji. If you break above the top of it, this is bearish. The other dojis that you're going to see, like the daddy long leg or just a straight doji, it's a simple matter of the market doesn't know what to do. You just take the trade in whichever direction it breaks. You want to do these on longer time frames. Like a 5-minute doji doesn't really mean that much. A spinning top is simply a doji with a little bit more of a bottom. And top spread here in the daily, or in the daily action. So, for example, that might be filled. So there was a difference between the open and the close, although very minor. A spinning top typically is traded the same way, but there is a bit of a difference. A spinning top doesn't necessarily word itself in the vein of it being the top of the market. It's more like, the old tops that kids used to play with, the spinning top. You just spin it and it would go around. So that's really the difference. They're traded pretty much the same way. In this chart here, I have a doji that I'm looking at. We break the top of it and we go higher. It's a daily chart of eBay. Again, though, dojis for me aren't as important by themselves as they are in reference to where they're placed. Now, this was placed on support, so that might have been a decent trade signal. Dojis are very common to be referred to, so at the very least, you need to understand what one is. As you look, it's just basically, this is a little bit more of a long-legged doji. We break the top of that. It's a nice rally in the short term. Could make an argument for a bit of maybe a gravestone doji there, followed by another one. There is a rally, though, and a shooting star and finally break down. And that's the thing about dojis. They're just not quite as reliable. A lot of times, what you want to see is several in a row, and then a break in one direction or the other is a bit more believable. This is a spinning top. Now, a spinning top, I like it as a reversal signal, but it can also mean continuation. The reason I like it as a reversal signal is because a lot of times you see them at the top of a move like this. Either way, though, and this could have gone either way. If we break below it, it's a short signal, time to start selling. If we break above it, well, what does that mean? That means that we're continuing, we're expanding the buying pressure to the upside. This suggests that maybe we had taken a break, because you have to realize a line chart of this weekly move would have been like this. And then once we got up here to the spinning top, this week would have been like that. And if we break higher, then it just simply means there's fresh new buying. But if we break lower, it shows that we've run out of momentum and a pullback is imminent. So both these candlesticks are pretty useful, just in the right context. Again, higher time frames tend to matter more. You always want to go with your support and resistance if you can. That, of course, is going to matter more than anything else. So keep that in mind. Do trade these a lot of times with support and resistance, or maybe an accompanying candlestick at times, but these are very commonly referred to, so you certainly should at least understand what they are. Hello and welcome back to Technical Analysis Bootcamp by Wealthy Education. In this video, I'm taking a look at the hammer and the hanging man. Now, the first thing that I will say about this pattern, this candlestick pattern, or candlestick, I should say, is that it's the same thing. It really comes down to where it's placed. Now, a hammer, called because of the pole, the mallet shape of it, looks like this on a line chart. So think about what that means. In this case, this is a week, but it means for whatever time period you're trading, that a lot of people were shorting and now they're losing money. So if you break above the top of that, everybody in that candlestick is losing money. That's a hammer. That's a bottoming pattern. Well, what happens if this candle forms at the top of a move? Well, what this means is that you're in a rally. People have sold off. The sellers are a little underwater. So is it continuation? It could be. It does turn out to be continuation sometimes. But what happens when you break down below the bottom of it? That is the hanging man. And everybody who is long, not only from the initial surge higher, but from the rebound, is now underwater and they need to sell, pushing prices lower. Remember, candlesticks are just a representation of the psychology of the market. They're very common. So there's a hammer. And if you look at this chart, you can clearly see that there should be support in that area. So it makes perfect sense that we would rally. After a while, though, we go towards resistance just above $60, and we form this candlestick. And the question then, and you don't know until you break down or above it, is it an attempt for the buyers to push even higher? You know, they've had a little bit of a pullback during that week, or are we breaking down? Well, you can see that we pierced the bottom of that candlestick, thereby making it technically a hanging man, and then we formed another one right after it. These candlesticks shouldn't be traded in anticipation. They should be traded on the next candlestick if we break above or below. You can clearly see that we broke down rather significantly after that. So if you were just trading these patterns by themselves, or these candlesticks by themselves, you would have gone long here, you would have gone long here, could have shorted there, bought here, shorted there, maybe added to shorts there, bought here, and you would still be short. But also another way to trade this, let's say you took this short position here based upon these two hanging mans. Well, once you get a hammer, you know that's a sign that we're going to bounce. You just put your stop loss above it, and you take your profit. Yes, you missed some of the move, but really this was a pretty good move. $6.50 over the course of a month and a half or so. The hammer here, you know, could have been the beginning of a basing position, you know, so you just add. Maybe you get out here because of breaking below the hanging man, but you can see that you form a hammer here as well, just above, right in the same range. So that's another reason to go long. These are great candlesticks to trade, and I know several traders who only trade these candlesticks, hanging mans, hammers, and then what we're going to look at in the next video, inverted hammers and shooting stars. One other thing that I would point out is that when you take these trades, you know, what's the stop loss? Well, they're really unlike some consolidation patterns, for example, there is no real measuring stick as to what you're aiming for. But the one thing that you can say is that if you're buying, like this hammer here, your stop loss would be underneath, because then it would negate the entire trade. If you're selling a hanging man, then your stop loss needs to go above it. Pretty straightforward. Excellent signals. Again, like I said, I know several people who that's all they trade are these candlestick formations. Hello and welcome back to Technical Analysis Bootcamp by Wealthy Education. In this video, inverted hammer and shooting star candlesticks. So a inverted hammer, you learned about hammers last go around. An inverted one is exactly what it sounds like. It is an inverted hammer. It's an upside down hammer. A shooting star looks just like that as well. So just like in the hammer and hanging man video, they're just variations upon each other. Shooting star, this is supposed to be a star falling out of the heavens. That's what the Japanese envisioned it as. Tends to appear at the end of an uptrend or a bounce, showing signs of exhaustion, because think about what's going on in this candlestick. In this case, it's the daily chart. These buyers pushed higher, and now all of a sudden, most of them during that day are underwater. And if we break down below the bottom of this candlestick, the entire day is filled with buyers that are losing money. They have to short the market, sell their stock, whatever, in order to flatten your position out. Stop losing money. So shooting star on an extended run higher or a pullback in a downtrend is an excellent signal. Just like with the other candlesticks in the last video, if we break the top of it, that is a sign that the trade is not going to work out. The inverted hammer is just simply the same candlestick, but at the bottom of a move lower. And in this case, I'll go ahead and draw another one out. In this case, what you get is a move lower, and then the buyers come in and try to push the market higher, but fail. So one of two things is going to happen. If we break above the top of this candlestick, that shows another surge higher. That shows real conviction, and that's a very bullish sign, and a lot of the short sellers are in trouble. But if we break down below the bottom of it, it's a continuation pattern. It shows that basically this day the buyers came in, they couldn't really hold on to their gains, and then we continue to go lower. So at the end of the day, the reality is it's almost like a binary trade. Whichever side of the candlestick that you break is where you go. So let's take a look here. eBay daily chart. I got a couple examples here. This is the inverted hammer. You can see that we were down, down, down. The buyers came in and then got especially aggressive and really pushed to the upside. However, once we got to this area that was previous support, resistance kicked in, and we ended up forming a shooting star, which was also a sell signal. This is technically a shooting star, and technically it did go lower, and here as well, it did work out. A hammer came in from the last video, and we bounced. You can see that it's basically the same pattern. Again, it's just the opposite direction of the last video. There's a shooting star there, which if you did not take this trade, once you got this massive red candle after a hanging man from last video, this shooting star shows that there's a lot of resistance there. So even if you don't use them directly right away, pay attention to them down the road. Another thing that I would point out is ascending triangle pattern that failed. Remember, a failed pattern can be a signal at times as well. Or you could just simply say a trend line break. So there's a lot of reasons this looks bearish. But it all more or less started with this candlestick here. And that shows the importance of shooting stars, inverted hammers, etc. And as I said in the last video, I know traders that make an entire living off of trading just that candlestick shape. They appear often enough that you can get involved in the market. Higher time frames, of course, mean more, but I'll go ahead and zoom down to 15 minutes. Without even looking at this chart previously, I know I'll find examples. There's one there where we broke down. There's a hammer there that didn't quite work out, but eventually did. There's a hammer there that most certainly worked out after a nice gap higher. This could be a hanging man and break down below there. So you can just see these candlesticks. I wouldn't say, I wouldn't go so far as to call them the Holy Grail, but they certainly are very useful. And again, they happen often enough that you should be able to take plenty of trades based upon just these candlesticks. Match them up with support and resistance, and you've got the basis of a very solid, simplistic system. Hello and welcome back to Technical Analysis Bootcamp by Wealthy Education. In this video, red and green Marubozu candlesticks. A Marubozu is simply, well, first of all, the translation in Japanese is bald man. And what this means is there's no wicks. It's simply just a candlestick that opens and closes in one direction. Red, of course, being negative. Green, of course, being positive. And there is no doubt as to what the market is thinking during that time frame. So, for example, this is an hourly chart, and if the Marubozu is red, I'll go ahead and draw the line charts. If it's red, you open up at this price and you just drop. There is no attempt at rallying. That's a very negative sign. If there's just one tick, one direction or the other, technically it's not a Marubozu. In a green one, the buyers come in and just overwhelm. Pretty straightforward. They're great signals. They don't happen all the time. Now, you're looking at the chart and you see a lot that are very close, but you don't see many that are a typical Marubozu, and that's what makes them so interesting. On this chart here, on the hourly candlesticks, you can see that there is a green one here. There's no shade, no wick, no nothing. There is a green one here as well. You get two in a handful of hours, and then the market rallies. Not a huge surprise, quite frankly, because it shows that the sellers just aren't that aggressive. Over here in the eBay 15-minute candlestick chart, you can see that there's a red one here. Think about what happened. You had the market starting to roll over slightly anyways, and then you just spent 15 minutes going straight down. That was the beginning of a move much lower. Like with anything else, you really want to see support and resistance involved. So you can see that was resistance. Previous one had support just underneath. And support and resistance really, these are great candlesticks. These are excellent candlesticks, actually, because they don't happen. Most of the time you get something like this where you get a shade, just a tiny little shade. But like with anything else, you want to start with support and resistance first. Pay attention to that. Look for the candlestick and trade. Now, these are very simple to trade. They're very obvious. They're very straightforward. So when they do happen, because they're rare, it's time to stand up and take notice. Hello and welcome back to Technical Analysis Bootcamp from Wealthy Education. In this video, bullish and bearish harami. Now, harami is a word for pregnant lady, or it's an expression for pregnant lady in Japanese. And what you get in this candlestick pattern, there's two candlesticks that make up the harami. And basically, it is a larger candlestick followed by a shorter candlestick, and there's the baby. There's the mother and the baby. That's the idea. There involves a gap, So by its very nature, it tends to be either the first candle of the day or a daily candlestick. And the idea is that in the case of a bullish harami, if we're falling and we continue to drift lower, and then one day we just gap higher and lose some of the downward pressure, the idea is that we're running out of momentum and it's time to turn around and start going higher. If we're rallying and we see this bearish harami, that means that we're going higher, and then one day we get a gap lower and we just kind of hang out, and it shows a lack of momentum and perhaps a reversal. So let's take a look at a couple of examples. This right here is a bullish harami. We're in a downtrend. We had a very strong negative day, followed by one that gapped up a little higher and then just kind of hang out there. We have the same thing a couple days later, and you can see that once we clear the top of the mother candlestick, it's time to start buying. And that's your signal. A lot of times you'll put your stop loss at the bottom and your entry at the top of the mother. Or you could go down to here with your stop loss down there. It's entirely up to you, but generally you want to take the larger of the two patterns. Over here, in another example, you can see that we have the mother and the baby. There's your stop loss, there's your entry, and we just broke down. And the beauty of this is there was a downtrend to begin with. We kind of pulled back and then we continued. The question inevitably arises, does it have to be alternating colors? The answer is no. So in this case, you can see that we rallied quite a bit. Now on the mother day, we kind of rolled over a little bit. We gapped a little higher the next day and then kind of rolled over a little bit. Maybe not enough to break down below the mother, but it shows that the sellers are starting to come in, get a little bit more aggressive. Then the next thing you know, on this third candlestick, we broke down. So take a look at this 2 candlestick pattern. Again, you need a market gapping to make this happen. So it's either the first candlestick of the day or it will be a daily candlestick. But they do tend to be well publicized. A lot of people pay attention to this. They do tend to be nice little signals for trend changes. Hello and welcome back to Technical Analysis Bootcamp by Wealthy Education. This video is going to feature bullish and bearish engulfing candles. So this is a 2 candlestick pattern. Essentially what you have is you have a candlestick that gets followed by a much bigger candlestick. Whether it's bullish or bearish depends on what the trend had been previously. So, for example, what you're looking at here is one of 2 things, depending on the colors of the candlesticks. You're really looking at a downtrend, which the next day may have gapped lower and then shot much higher. And think about what that does. That wipes out the sellers from the day before, and most of the time a couple days before. If it's a truly large engulfing candlestick, it'll do a lot of damage in a very short amount of time. You know, you gap lower and the market just turns right back around. That scares a lot of people who are short. If we're going long and it ends up being a bearish candlestick, this would be red then. It's a rally. You get a quiet day. You get a gap higher, so everybody's happy because they think it's going to continue. And then all of a sudden something horrible happens to price action and you wipe out several days. There does need to be a gap, though, because the second candle needs to engulf the other one, so it has to be higher and lower than the previous candlestick. On this chart here of Yelp, I've got a couple bullish engulfing candlesticks. You can see that clearly swallows the candlestick before, and so does that. So how do we trade it? Well, the stop loss goes on the other side of the candlestick, because if we were to turn around and wipe out this candlestick, that would be a very negative sign. As far as the entry is concerned, it's just simply a break of the candlestick. And you can see both times it's worked out for nice, profitable trading afterwards. With the bearish candlestick, and this isn't as extreme of an example, but it certainly is a valid one. You can see that we had a couple of candlesticks here that got swallowed by this one. And what I also like about this is that there is a shooting star right here, and then this. So on a break below the bottom of this candlestick, your stop loss is above this candle, and you continue to go lower. And these happen enough that you see them quite often on charts. Now, I don't want to say they're common, reasonably common. They're not, I wouldn't call them rare because they do happen. But when you look through daily charts, a lot of times you'll see them pop up, and then you look back at the chart and you go, oh yeah, there was a reversal area there. And, in hindsight, it's always 2020. That's the thing about these things. You have to trust the patterns. You have to know that over time they work out. There's a slight one there. This chart here shows quite a few close. Like, for example, this is close, but no cigar. This would be a bullish engulfing candlestick. Not my favorite kind, though, because I really like to see, the more pronounced it is, obviously, the more interesting it is. Because you wanted to catch enough people's attention that the market moves right along with you. There are enough people out there going, hey, this is a sell signal. Like this city one was pretty negative. Your stop loss was up here. You got all the way down to the previous resistance level before it turned back around. You also want to, when you trade these, so this is a perfect example of one that, although it is a nasty bearish engulfing candlestick, you would know that somewhere right here around 70, you're probably going to see some buyers due to the previous resistance. Well, at this point, this is a candlestick that makes you risk $3.90 to pick up 2. So that's not a trade. It's doable, but the risk to reward just isn't there. Clearly, though, with that volume that probably attracted a lot of people, I suspect that they probably shorted it, took some profits based upon some news or something. But that is an example of looking at just the candlestick and how much trouble it can get you in. This is technically a bearish engulfing candlestick, but look at all of this support just below. So do you really want it to risk a couple bucks to pick up, say, 50 cents? And no, you have to use some common sense. But they are excellent signals when they do happen, especially when you have some room to run. I like them when they show up and at various extremes. So with that being the case, take a look on typically the daily charts. You will get them perhaps on an hourly chart at the open, but this is generally a daily or even weekly signal that people will use to determine the trend. And then if they are shorter term traders, use it as a guideline as to how to enter the markets. Hello and welcome back to Technical Analysis Bootcamp. In this video, tweezer tops and tweezer bottoms. A tweezer top is simply a candlestick, 2 candlesticks I should say, that form at the top of a run higher with similar length, almost identical or even identical length wicks. Tweezer bottom, of course, is the exact opposite. At the bottom of a downtrend, you could see a couple of candlesticks like this. One way to think of this is dual. They don't necessarily have to be, but you could say that they're dual hammers or shooting stars. But the thing that you're focusing on is the fact that the buyers or sellers couldn't push beyond a certain point, and they have tried a couple of times. So on a break below the pattern over here in the tweezer top, it's a sell signal. The tweezer bottom, it's a buy signal if we break above the top of it. Stop loss on the other side. I mean, it makes sense. Think about it. In this scenario, they pushed higher, and now we've got 2 days of losers, or 2 candlesticks of potential losers here on any move. Lower, you'll have a lot of people selling their stock. Short covering will happen over here because this is what you're looking at if they can't break down. Now, conversely, if you do break beyond the tweezers, that's a very strong sign. Not necessarily a pattern, it's just an observation. So on the charts here, I've got tweezer tops here within a few cents of each other, a couple of shooting stars. On the daily chart, now these are daily candlesticks, so there's a little more to it. They look a bit small here, but they do have a decent range, about $1 range. So clearly, right around 73.5. Buyers just shouldn't get above, and of course, that started the next leg lower. Beyond that, it's an area that has been both supportive and resistive. So you would look for some type of action there anyway. So nice setup. Over here on the Wells Fargo chart, we have a couple of examples on the hourly. Couple tweezer bottom there on a pullback, went higher. Tweezer bottoms here on a pretty significant pullback, right into where you would expect buyers to return, and we continue to go higher. So basically what you're just looking for is 2 wicks that stop at about the same price. And that is your tweezers. It's supposed to look like tweezers. And of course, top being after a rally, bottom being after a breakdown. Hello and welcome back to Technical Analysis Bootcamp by Wealthy Education. In this video, I'll take a look at morning and evening doji stars. So you can probably gather that there's a doji involved in this pattern. Hence the name. It's a 3 candlestick pattern. And I will draw a couple out. And I'll color them in, then I'll explain what's going on here. You have the black candlesticks are red. Or black if you're doing black and white candlestick charting. You have a trend going into both of these patterns. And the reason that this is called, the first one's called an evening star, is because the stars come out at night. They fall, the sun falls in the evening. So there's a couple different thought processes on that. A morning star means the sun is starting to rise in the morning. So it's a bullish sign. You have an uptrend. You have a continuation of the uptrend. You have a gap higher. It forms a doji. This is an evening doji star. And then we gap lower to form a negative candlestick. A break of that third candlestick is a sell signal. In a downtrend, you have the morning star doji. After a negative candlestick, a gap lower and a doji showing indecision, and then buyers coming in to pick the market up on the third day. After that third day, and a break above that candlestick, it's a buying pattern. Now, they don't necessarily jump right out at you at all times because they don't always look this clear. For example, here is a morning star because we are in a downtrend, a continuation of a downtrend. And then on this candlestick, we gapped lower, formed a doji, gapped higher, and then broke above that. And it was a short-term buying opportunity up to the resistance. This is a daily chart, so these are bigger moves than they might appear. And over here in Citigroup, here's a evening star because we are continuing the move higher. Granted, it's been very volatile. We gap higher, we form a doji, we gap lower. A breakdown below this candle sends the market much lower. Now, these are the type of patterns you're going to see on daily charts more than anything else. You don't typically see them on short-term charts unless maybe the star itself is the first candlestick of the next day. So this is more of a investor's type of pattern, but they are well known, well publicized. If you look at stock screeners online, a lot of them have this possible pattern that they will look for. So with that many people paying attention to them, they do tend to be reasonably reliable. Hello and welcome back to Wealthy Education's Technical Analysis Bootcamp. In this video, 3 white soldiers and 3 black crows. Now, keep in mind that we use red and green like many of you do, so white should translate to green, while black should translate to red. But this was originally acknowledged when candlesticks were all black and white, and hence the name. So I'm coloring these in. These are either going to be black or red, depending on your charting. But it does mean the same thing. These will be white or green. So what we're looking at here are 3 white soldiers, or 3 green soldiers, if you will, and 3 black crows. These are daily candlesticks or above. And what happens is you get a day that's bullish, you get a gap lower, you get another day that's bullish, you get a gap lower, and then you get a third day that's bullish. And think about what that means. That means that traders are willing to fight and push every time they get a little bit of value. There is some debate as to whether it needs to be within the body or the wick. Most people accept the wicks as part of the range. So, for example, as long as we opened up a gap lower from the opening or within the wick, 3 green candles in a row is a reason to buy. Over here, think about what's happening here. We're breaking down. We gap higher, the buyers try to push it up, they fail. Gap higher, the buyers try to push it up, and they fail again. So it's just a matter of resiliency. This is a small example of 3 white soldiers. We continue to gap lower at the open and continue to go higher later in the day. And we push to an area that was previous resistance. And everybody loves Apple on Wall Street, so that shouldn't have been a huge surprise. But you can see it's a definite shift in the attitude. Over here in Ford, we have a gap lower and then a breakdown. A gap higher and then a breakdown, a gap higher and then a breakdown. And you can see that the 3 black crows certainly played out a lot of negativity. This was the beginning, and it just shows how resilient the sellers were here at 1720, and then they eventually broke things down. As far as stop losses are concerned, depending on in this case, these are your negative candlesticks. Your stop loss goes on the other side of the 3 candlesticks, and by that very nature alone, it does tend to be a bit of a longer term signal. It's more of an investor's signal than a day trader signal. So keep that in mind, because you're not going to get these gaps 3 in a row on a daily chart or on a intraday chart. On a daily chart, weekly chart, certainly possible. And it just shows how much the sellers in this case are starting to take over, or in the white soldiers, how the buyers are starting to come in and push things. It's basically a complete change in psychology. Hello and welcome back to Technical Analysis Bootcamp by Wealthy Education. This video will feature the abandoned baby candlestick pattern. There's both a bullish and a bearish version of this. They are pretty rare though. So, in fact, so rare that I was having trouble finding some examples. They happen on daily charts more than anything else, but they can happen on shorter time frames. You just need gaps, and that's what we're looking for. So essentially what it is a scenario like with a bearish one. You're in an uptrend, you get a candlestick print, you get a gap higher, and then you get a gap lower. Well, think about what that means. We're going right along. You get a day that gaps higher. Okay, well, that's good. But all of a sudden, you really don't do much that day. Someone undecided. And then you gap lower. So every trader that traded during that day to the upside is now trapped. And once you break below the initial candlestick, the first candlestick, everybody there is trapped. In a selling pattern, same thing. This is a bullish abandoned baby. So we've been selling for quite some time. The sellers continue to push lower. We gap lower. They're okay with that. Don't do a lot that day. Kind of gives a little bit of pause. And then the buyers come in and gap it to the upside. The third day, break above that candlestick, is a buying opportunity. So bearish is this is going to be almost identical to the Evening Star and Morning Star dojis. The difference is the gap. That's really it. That's the only difference. So you can see we've got a gap here. This price does not break above the bottom of this candlestick, and then we gap higher. That is a bullish abandoned baby pattern. You do see them on short-term charts, but those tend to lack liquidity. What you want to see is these things form at areas that would make sense. So this is an area of support. It makes perfect sense that we turned around on this daily chart and rallied quite stringently. The biggest problem with this pattern, again, is that you don't see them very often. You see variations of it. So, for example, you get this and you gap higher and you break down, and you could say that essentially tells you basically the same thing. The line for that would be, a line chart would be like that, and that's similar because you are gapping to the upside after trying to break down. But the actual abandoned baby pattern needs two gaps with a doji or a basically unchanged candle in the center of it. Just a quick note to thank you for taking this course, Technical Analysis Bootcamp. Again, thank you for watching, and if you have any questions, please don't hesitate to reach out to us or post your questions in our forum.
Hi there. Welcome to the Value Investing Fundamentals course, brought to you by Wealthy Education. In this course, I'll teach you how to get started in value investing fast. You'll learn exactly what you'll need to do when evaluating a company and what you'll need to look for when picking a stock to invest in. So if you're just starting out, or you're looking to learn value investing fast so you can start growing your retirement funds or portfolio more quickly, this is the course for you. Here's exactly what you'll learn in this course. In this course, we'll provide you with a strong value investing foundation. I'll teach you 3 easy, simple steps that you can follow to find and invest profitably in value stocks. You'll learn exactly how to assess a company by looking at 3 different types of value. This is critical because most investors only look at 1 or hopefully 2 when evaluating a company that they want to invest in. And that's why they end up buying a cheap stock at a much higher price. You'll also learn how to use a margin of safety to significantly reduce risks on your investments and correct all the mistakes you might make in your valuation process. I'll also teach you 7 golden value investing principles that every stock investor should live by. And in the last module, we'll also talk about 5 different things you can follow to identify if a company has a sustainable competitive advantage, so it can compete with other companies within the same industry. And we'll also make a complete value investing roadmap for you so you know exactly what you need to do now and what you'll need to do next. You'll know exactly your next steps and what you'll need to learn to become a successful value investor. Hey guys, welcome to Module 1. In this module, I'll help you understand quickly how the value investing strategy works in the real world. We'll dive into what exactly value investing is, how it works, and I'll show you 3 simple steps to implement this strategy so that you can profit from the stock market and grow your money. Okay, now let's get started. So what exactly is value investing? Value investing is simply an investment strategy where stocks are selected that trade for less than their intrinsic value. So what does that mean? Intrinsic value here is a real or true value of a company. By doing value investing, you simply invest in stocks that are currently undervalued or become temporarily cheap. Value investing is driven by the idea that there are ways to benefit financially from the events that cause stock market prices to swing up and down. So when there are rumors or bad news about a company, its stock price will drop. And as a value investor, you simply take advantage of these events and buy the company's stock at a much lower price. On one level, a stock's value is reflected in its current market price. Since the market price indicates how much investors are willing to pay for a stock at any given time, it indicates the stock's market value. But the key point to note in value investing is that a stock's market value is not the same thing as its fundamental or intrinsic value. Sometimes businesses can become temporarily popular or unpopular for a variety of reasons that have little to do with the true worth of their revenues, net assets, or their future income potential. So, as a value investor, our job is to find a company's true value and compare it with the current market price, so we can determine if the stock is worth buying or not. When a company's stock is undervalued, it means that it's selling at a price well below the value of its current and predicted cash flows. For example, a stock is selling at $3.21 a share, and you find that it's actually worth $5.67 a share. So this simply means this stock is undervalued, and it's a good buying opportunity because you know that the stock price will likely go up in the near future. So you simply buy low at $3.21 a share and then sell high at $5.67 a share, for example. In this case, you can make around $2.50 a share in profit. At the same time, a stock that's overvalued is one that's selling at an inflated price, well beyond its true value or its predicted cash flows. For example, you find a stock that's selling at $5.67 a share, and after applying some valuation techniques, you know that this stock is only worth $3.21 a share. So this means it's overvalued or expensive to buy. There are chances that its price will drop in the near future, so we simply sell it or avoid buying it. You see, value investing can tell you exactly whether or not a stock is a worthwhile investment. With this information, you can easily profit from the stock market. So what is the smartest strategy for buying and selling stocks? As a value investor, we'll buy on bad news and sell on good news. Do you know why? Well, most investors will do the opposite. They buy on good news and sell on bad news. You know, that's risky because they can easily buy an overvalued stock which likely drops in value. For playing safe with the stock market, why don't we wait until there are some rumors or bad news? These events will likely cause the stock price to drop temporarily, and the stock can easily become undervalued. And then we can buy low and sell high for making an easy profit. And similarly, we'll sell on good news because chances are the stock price will surge temporarily during these events and sometimes become overvalued. We simply sell at a high price and take the profit. So here's a quick tip. If an undervalued company is financially strong, with a solid profit history and promising future earnings, its market price is very likely to rebound after a temporary downswing caused by investor fear or disfavor. This means solid companies with efficient operations and strong financial performance are always winners. We don't care when their stock price drops because of bad news or rumors. Their financial performance proves that they can survive market downturns, and their market values will likely go back up and reach closer to their intrinsic values. So, to be a profitable value investor, all you need to do is find companies with a strong fundamental performance. In the next lecture, I'll teach you how to implement the value investing strategy. In this video, we'll talk about 3 easy, simple steps that you can follow to invest in a value stock. The best value investing strategy starts with learning to identify fundamentally strong companies. If you attempt to profit by buying stocks that have simply dropped in price without first ensuring that they have the underlying ability to eventually recover, there's a good chance you'll experience some financial loss instead. An effective value investing formula dictates that we must first look for strong businesses, buy when their stock is undervalued, and sell when it rebounds or becomes overvalued. Now, let's dive into each step so you can understand clearly what to do and how you can profit by investing in undervalued stocks. Value companies are not named for their positive market values, since every company's stock price fluctuates on a regular basis in conjunction with individual news events or occurrences within the market as a whole. A fundamentally strong business is known as a value company because it possesses actual inherent worth in terms of its consistent earnings, dividends, and cash flows. So, you want to make sure you'll only invest in companies with a consistent growth in earnings, dividends, and cash flows. These companies usually have a sustainable competitive advantage over their rivals that keeps them in the game, regardless of what their stock price may be doing from day to day. And it's this competitive edge that gives businesses a protective economic moat. Economic moat is something that helps a business remain financially competitive over the long term. We'll go into more detail about economic moats in the next modules. Even if negative events can cause a fundamentally strong company's stock price to dip, and here's an important thing, if that company can maintain its ability to continue operations as usual, it will rebound in time to a market price that is more in keeping with its true value. I want you to note that investors tend to have emotionally short memories. They won't remember what happened with the company in the past, and they only care about the present and the future. So as long as a company continues to demonstrate a consistently growing net income and cash flow, it's very likely to not only eventually regain its former glory after a price drop, but to become overvalued someday because investors start to recognize all over again what a great value it represents. And when looking for fundamentally strong businesses, some additional factors you should keep in mind are low debt and the presence of a strong and responsive management team. Overall, if a company has a history of performing well, you can predict that it will continue to do so over the long term. Once you've identified businesses that are fundamentally strong and that have a high intrinsic value, your next step is to add them to your watch list so you can buy them if and when they become undervalued. Under normal circumstances, stocks that are financially strong and that demonstrate promising future prospects are maybe too expensive to buy. For this reason, a fundamentally strong business doesn't always represent a good investment, because its stock value will have little potential to increase if you buy it when it's already trading at a price that's more or less in line with the company's intrinsic value. So in short, you need to learn how to find undervalued stocks so you don't end up buying them at the wrong time. But there's good news. A strong company can easily become temporarily undervalued for a number of reasons. These can include one-time events, such as internal scandals or negative news reports that cause disillusionment, but make sure that these events don't cause the company to lose its competitive edge or its ability to go about its business as usual. If you wait for such occurrences as a company failing to meet its projected earnings, a downturn in the economy, a significant change in a company's business environment, or similar types of bad news, you'll find many great opportunities to buy a great stock at a very low price. These events will likely cause a stock price to drop, and when this happens, chances are it will become undervalued or cheaper to buy. And as a value investor, you simply buy low and then sell high to make a profit. Now that you understand the best time to buy into a financially strong company is when its stock has become undervalued, you also need to know when to sell that stock in order to make a profit. Although we know that a high-quality company can be temporarily affected by negative market news that causes its stock price to plunge, we also know it's very likely to recover over the long term. And in the same way that bad news can cause a company's stock price to drop, good news can have the opposite effect and cause its price to surge during this recovery period. When a company publicly announces how well they did financially for the previous quarter, that makes investors feel excited, and they want to invest their money in that company. And when the demand increases, the stock price simply goes up. In either case, whether a business simply recovers its true value in time because of its intrinsic value, or becomes suddenly overvalued as the result of some positive event like share buyback, it will be the time to sell your stock and take your profit in the spirit of buying low and selling high. So I want to pay close attention to these events because they can help the stock price go up very quickly. And you'll also have to be quick to sell your stock and take the profit. Share buybacks and stock splits are common events that can lead to an increase in a company's stock price. Share buyback is a program by which a company buys back its own shares from the marketplace, usually because management thinks the shares are undervalued. And stock split happens when a company divides its existing shares into multiple shares to boost the liquidity of the shares. So as a value investor, we can take advantage of these golden opportunities to sell our stock at a temporarily high price and make a higher profit. And the stock price tends to go up during a bull market or economic upturns. And events like mergers and acquisitions can also lead to a significant movement in stocks. A merger is when two companies merge together. An acquisition is when one company buys out another company. So you need to pay attention to these events, especially the earnings announcement, because it happens almost every quarter, so we'll have at least 4 times a year to make big profits. In the next lecture, we'll talk about price and value, which is a very important topic in value investing. Okay, see you in the next video. Price is what you pay, value is what you get. Okay, now let's talk about price and value. Both price and value are the two sides of the same coin. Understanding the difference between price and value is important because it helps you sort out good investments from bad investments. So I want you to take a quick note here. Price and value are not always the same. Most inexperienced investors look at a stock's price to determine if it's cheap or expensive. They think that a $5 stock is cheaper than a $50 stock. Well, it seems cheaper because of the price tag. But they don't know that their $5 stock may be only worth $2 or $3, for example, while the $50 stock can be worth over $80 or maybe $100. So that's the difference between price and value. Looking at the price side is not investing. It's gambling because you have no idea about how much your stock is actually worth. Only considering the market price is the same as you go shopping. You buy a product because the shop tells you that there's a promotion. They discount the product and you feel you're buying something cheap. But the thing is, even with a discount, that shop can still make a profit because they're selling you a product at a price that's higher than its cost of production, so that product is overvalued. The same for the stock market. As a value investor, we need to look at the value side. So before making your investment in a company, you need to make sure that you'll only buy it when it's undervalued. There are 3 types of value that you need to know about if you want to be successful as a value investor. Evaluating these values carefully will show you a clear picture of how profitable a potential investment is. The first is relative value. The second is absolute value. And the third is perceived value. Now, let's dive into each of them in turn. Relative value can be determined by comparing a company's financial performance with that of its competitors within the same industry, and also with the industry average. The differences between a company with its rivals tells you exactly how well it's operating and generating profits. When a company is profitable and able to operate efficiently, that will make a significant contribution to its shareholders' value. This simply means the more profitable the company is, the more profitable you are as a shareholder. So to determine relative value, the easiest method you can use is performing a financial ratio analysis. We'll simply compare a company's profitability, efficiency, liquidity, and solvency ratios with that of its competitors and the industry average. The company with the best ratio values will be the best company in the industry, and it's a worthwhile investment in terms of its relative value. Financial ratio analysis is a big topic in value investing, so I'll teach you how to use financial ratios the right way in another course. But right now, you just need to know that it exists, and you'll need to learn about it later to master your value investing skills. Okay, the second value that we're going to talk about is the absolute value. In short, it's the company's intrinsic or real value. You'll need to perform a stock valuation to estimate your company's intrinsic value. Then compare its value with the current market price. If the intrinsic value is higher than the current market price, or the company's stock is selling at a price which is cheaper than it's actually worth, this means it's undervalued or cheap to buy. So, we'll consider buying it to make a profit when the price increases in the future. And on the other hand, if the intrinsic value is lower than the current market price, the stock is overvalued or expensive. We simply avoid buying this company's stock. So to determine absolute value, we'll use some valuation methods such as the discounted cash flow model or dividend discount model. Okay, the final one is the perceived value. Perceived value is the price that people are willing to pay for a product or service. And in the stock market game, it's the price that people are willing to pay for a share of a company. The perceived value is completely unrelated to the absolute value. The best example of perceived value is this picture. It's actually worth maybe just a few $100s to pay an artist to paint it. But guess what? It's worth millions of dollars. Why? Because there are people who are willing to pay that high price to own this picture. The selling price will totally depend on the perception of the buyers. And I want you to know this. The stock market also works on the perceived value, and the stock price of a company reflects the perception of investors like yourself. You can easily see perceived value in growth stocks, where companies are growing much faster than their competitors and the whole industry. So that's why investors are ready to take higher risks and pay a higher price for owning those stocks. And to determine the perceived value of a company, you'll need to do a qualitative research. You'll need to find out what people think about that company, how skillful and experienced its management is in growing their business, what the values are that the company brings to the world. And the only way to know this is spending a lot of time reading news, stock analyses, and customer reviews. In the next lecture, we'll talk about another important topic of value investing. That's the margin of safety, one of the most critical factors that will determine your value investing success. Okay, see you in the next video. In this video, we're going to talk about the margin of safety and how you can use it effectively to reduce risks on your investment and make a wiser investment decision. So what exactly is margin of safety? Margin of safety is simply the difference between the intrinsic value of a stock and its market price. For example, the market price of a stock is $6 a share. You find that its intrinsic value is about $10 a share. So in this case, we have a margin of safety of $4, or 40%. In fact, the higher the margin of safety, the lower the risk on your investments. The margin of safety is achieved when a stock is bought at a price which is sufficiently below underlying value to allow for human error, bad luck, or extreme volatility in a complex, unpredictable, and rapidly changing world. Or in other words, using a margin of safety will allow you to correct your mistakes in your investment analysis and valuation. Well, when it comes to stock valuation, we make mistakes all the time. Every valuation method is implemented based on assumptions. For example, when using the discounted cash flow model, you'll have to assume that a company's cash flow will grow at a consistent rate over the next 5 to 10 years. What will happen if its cash flow grows by 10% this year, 5% next year, and negative 8% in another year? You see, our valuation method is somewhat biased, and that's why the margin of safety concept is applied to value investing. So how much margin is acceptable? Well, it depends on how much bad luck you're willing to face, your risk tolerance, and how much money you can afford to lose. Losing some money is an inevitable part of investing. In fact, there's nothing you can do to prevent it. But to be a sensible and intelligent investor, you must take responsibility for ensuring that you never lose most or all of your money. If you think you can't afford to lose much from your stocks, it always pays to have a good margin of safety, say around 30 to 40%. This means that you must buy a $10 stock for not more than $6 or $7. Remember, the higher the margin of safety, the better. And also make sure that you will always use a margin of safety of at least 25% for the sake of your money's safety. In the next module, we'll dive into some investing principles that you should always keep in mind when investing in the stock market. Okay, see you in the next video. Hey guys, welcome to Module 2. In this module, we'll talk about some value investing principles. You don't have to be a legend to generate market-beating returns with a value investing strategy. But if you want to understand how to be a successful value investor, it will help to keep these principles in mind. Okay, the first point you need to acknowledge is that value investing is not gambling, and you should approach it with a full understanding of exactly what type of investor you are. And most importantly, you must understand exactly what you buy and why you buy it. Knowing the what and the why here is very important. Value investing isn't a passive strategy. Far from being a guessing game or a gamble, value investing is work. When evaluating a company, you should be able to answer the following questions and explain everything in your own words. What does the company you're investing in do? How does it make money? What are its competitors? What are the potential risks that it may take? And why do you expect its stock price to rise over time? It's important to know these things when you first invest, of course, but it's just as important to stay up to date on major developments affecting the company so that you can continue to answer those questions accurately. At a minimum, you should read the company's quarter reports and keep at least a half eye on news pertaining to the company so that you understand if its situation is changing. If something happens that lowers its intrinsic value, you'll need to reevaluate it. Do you still have a good reason to own the stock? If the company you own takes a turn for the worse, with no likely recovery on the horizon, selling its stock may be the best option, even if it means taking a loss. When it comes to investing, minimizing your risks is important, and that should be your first priority. So, that's principle number 1. Understand what you buy and why you buy it. See you in the next video. Okay, the second principle. Make sure you'll always invest in a cash-rich business. When a business is cash-rich, it means it always has abundant funds left over after paying all of its debts and expenses. It also means that its assets are liquid enough to be called upon should they be needed as an extra source of cash. So more cash simply means more liquidity. That's exactly what you'll want to look for as a value investor. And you should always make a point of investing in companies that have a strong cash position, because they're the ones most likely to pay regular dividends to their shareholders. At the same time, these companies are less likely to find themselves so strapped for cash that they are unable to service their debt loads when revenues dip or a recession hits. However, having a lot of cash is not always a good sign. You must find out if the management is utilizing their business cash well. Warren Buffett once said, "When people talk about cash being king, it's not king if it just sits there and never does anything." If the management can't utilize their business assets, it shows inefficiency in the company's operations, and that will be a red flag that you need to pay attention to. And finally, you'll want to look for cash-rich businesses with a long and uninterrupted history of dividend payments. When companies pay dividends on a consistent basis, they demonstrate stability and show a positive sign that after paying all expenses and debts, they still have a lot of cash left to pay dividends to you and other shareholders. And that helps increase shareholders' value, and in some way contributes to a growth in their stock's perceived value. Okay, that's principle number 2. Make sure you'll always invest in a cash-rich business. See you in the next video. Okay, besides looking for cash-rich companies, make sure you'll only invest your money in companies with a low level of debt. You're unlikely to find any well-established business that doesn't carry some level of financial liability. In fact, a little debt can be a good thing when it helps to provide the funding for business growth and expansion, since this type of activity tends to raise the overall value of a company. But that doesn't make it acceptable to invest in a business that's carrying a large debt load, since it's very easy for a company to get into trouble once it overextends itself financially and is no longer able to service or repay its loans. That is to say, having too much debt can lead to many financial troubles. So, as a value investor, you should be careful when picking a company to invest in. When looking at a company's financial statement, you'll find that there are 2 types of debt: short-term debts and long-term debts. For evaluating a company's short-term debts, you can use liquidity ratios. And for evaluating the long-term debts, you can use solvency ratios. To find out if a company's debt level is high or low, you can compare its debt ratios with that of its rivals and the industry average. And finally, you should also evaluate the company's ability to repay its short-term and long-term debts. If it can generate enough cash flow to pay its bills on time, there may not be any problem. However, if the company fails to pay its bills on time, it's going to have a problematic relationship with its suppliers and lenders, and that will affect the business in the long run. Remember that when you buy shares in any company, you are effectively lending that company your own hard-earned money. So make sure that you'll only seek out businesses with low debt loads and a reliable track record for repaying their debts. So that's principle number 3. See you in the next video. Okay, besides looking for low debt and cash-rich businesses, the next thing you'll want to consider is the quality of a company's management. In most cases, a company is only as successful as the people running it, and a big part of value investing is making sure that the business you buy into has a reliable, experienced, and forward-thinking management style behind it. One of the key factors in determining whether or not a business is on top of its game is to have a look at what gives it its competitive edge in the marketplace, and whether or not its management team has an ongoing plan in place for making the most of this competitive advantage. This means that management is not only acknowledging the competitive challenges that constantly threaten their company, but is adapting and responding to those challenges in a realistic and timely manner. To determine how well a company's management is doing in operating and expanding their business, you can use some efficiency ratios. And another great way to evaluate the quality of the management is looking at their company's competitive advantages. You need to make sure, to the best of your ability, that the people you are trusting your money with have proven themselves as effective decision makers and leaders within their industry. We'll dive deeper into how to identify a company's competitive advantages in the next module. Great companies should have great management teams. A great management team should focus on generating growth over time, which is the best way to reward long-term shareholders like yourself. So make sure you keep in mind principle number 4. Only look for companies that have both strong management and a sustained competitive advantages. And see you in the next video. Okay, let's talk about principle number 5. If you want to become a successful value investor, avoiding losses should be your first priority, even over generating investment gains. Remember rule number 1, never lose money. And rule number 2, never lose money. And I can tell you rule number 3 and number 4. Again, never lose money. Here's an interesting fact. It's simple math. If your portfolio's value drops by 20% and then grows by 20%, you've lost money. More to the point, in that situation, you need larger returns to meet your goals over time. That might lead you to take larger risks than you should, which could lead to more losses. As a value investor, you can minimize the risk of big losses by investing at a discount to a company's intrinsic value. And that's why you need to use the margin of safety as a part of your valuation process. Well, you may not always get market-beating growth, but if you can minimize losses and the need to recover from those losses, you'll need less growth to meet your investing goals over time. And besides giving yourself a high margin of safety, there are many ways you can go about minimizing losses on your investments. For example, you can easily avoid common costly mistakes like overtrading by only investing in companies that you're sure that you'll make a profit with. And before making any trade, you should always have an entry and exit strategy in mind. And don't forget to place a stop loss to protect your money. Okay, that's principle number 5. Never lose money. See you in the next video. Value investing strategies are not for those investors looking to move quickly in and out of stocks on a daily or even an annual basis. Warren Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." When you invest in value companies, you must invest for the long term, and think in terms of years or at least months, not days or weeks. In fact, Buffett believes that all short-term price movements in the stock market should be disregarded by value investors, beyond using them as an indication of the best times to potentially pick up some new holdings. You should keep in mind that long-term investments are normally those that have lower risks. Rather than watching daily stock prices, you should spend that time keeping your eye on the operational performance of the companies in your portfolio. And rather than allowing market volatility to lead you into hasty and emotional investment decisions, you should continue to base your opinions of a company's value on facts. Sometimes it can take a company a long time to see its share price rise to match its intrinsic value. If you have the time, and if you won't need the money for many years, you have a huge advantage over investors with the opposite circumstances. You can buy, perhaps at a discount, when they need to sell. Good companies can trade at valuations that seem very low for years. This can happen when investors' attention is focused elsewhere, on hot tech stocks, for example, or when a sector is out of favor. Even if it takes several years to happen, the general principle holds. The market is usually efficient over the long run, and eventually, a stock's price will reflect the company's true value. If you've bought the stock at a discount, you'll make money, or a lot of money, if you sell it once its price rises to something closer to its intrinsic value. Having the patience to wait until that happens is one key to success as a value investor. So that's principle number 6. Make sure you have a long-term investment strategy in mind, and patience is key to your investment success. Okay, the final principle that you should keep in mind: know when to sell your stocks. Almost as difficult as knowing when to buy your stocks is figuring out when it's the right time to sell them. If a company is performing well, with no indication that its future growth potential has diminished in any way, then you can hold on to their stock until its market price exceeds its intrinsic value. Or in other words, you can hold your stocks until it becomes overvalued. Sometimes, however, stocks can become overvalued for the wrong reason, and this can be a warning that a severe crisis is in the works. The most common event that leads to a movement in stock prices is when companies release news about a new product line or management change. It can be good or bad news. If it's a positive reaction, the company's stock price will rise. If it's bad, the stock price goes down. Without question, the most important factor that affects a company's value, and therefore its stock price, is its earnings. Earnings are the profit a company makes, and in the long run, no company can survive without them. If a company's earnings are better than expected, its stock price increases. But if a company's results are worse than expected, its stock price will fall. Simple as that. Another factor is market volatility. Stock market volatility often leads to stock price declines across the board, even for companies with strong business fundamentals. Market downturns could be due to several reasons: changes in the economy, profit-taking after strong rallies, and geopolitical events. However, in such circumstances, stock prices may just decline temporarily, and chances are they'll recover in a few months. So you can take advantage of these scenarios to sell your stock at a high price and then buy it back at a lower price. It's a simple strategy for guaranteed profits. Another circumstance you should consider selling your stocks before everything gets worse is when the company suddenly cuts dividends without any acceptable reasons. As a value investor, we understand the importance of dividends, so you need to be wary when dividends are suddenly cut. 90% of the time, your stock price will plunge because investors no longer feel safe about their investments, and they're so concerned about the business performance. So, that's principle number 7. Know when to sell your stocks. In the next module, I'll teach you how to identify a company's economic moats so you can easily determine if a company has sustainable competitive advantages over its industry peers. Okay, see you in the next video. Hey guys, welcome to Module 3. In this module, I'll teach you how to identify a company's economic moat, as well as understand how wide it is and why it's so important. So what exactly is an economic moat? While regular cash flow, well-managed debt, and a competitive advantage all play a role in enduring business success, the ability to develop a wide economic moat is the key to what separates the winners from the losers over the long term. What we refer to as a moat is what other people might call competitive advantage. It's something that differentiates a company from its nearest competitors. In very simple words, an economic moat is basically anything that gives a business some form of built-in protection for its ongoing generation of cash flow. If you picture a company as a castle that is constantly under attack by its enemies, or competitors, you'll have a better understanding of just how important an economic moat is in helping a business to thrive and survive in the marketplace. And here's what you should keep in mind when evaluating a company. Without one or more protective moats firmly in place, a formerly profitable business will soon find itself unable to maintain its market share, and its revenues will begin to drop off. This also means that a company without a unique economic moat can't survive in the long term. It'll be harder for it to compete with other companies within the same industry, and it'll be harder for it to recover from market downturns, recessions, or financial disasters. Remember that a competitive advantage is essentially any factor that allows a company to provide goods or services that are similar to those offered by its competitors, and at the same time, outperform those competitors in profits. So the easiest way to determine the size of a company's economic moat is look at its historical operating performance. To evaluate a company's operating performance, you can use some profitability and efficiency ratios. Then you can compare its ratio values with that of its competitors and the industry average. If the company you're evaluating maintains a better and more efficient operating performance than its competitors, it's clearly the winner, and you can expect that it will survive in the next decades. In the next video, I'll give you a complete list of economic moats that a company may have, and I'll also talk a little bit more about economic moats and why they're so important. Okay, see you in the next video. The concept of the economic moat comes from Warren Buffett. He evaluates a company's economic moats to determine its ability to maintain a competitive advantage over its rivals, and thus protect its long-term profitability and market share. So why do companies need a competitive advantage? A competitive advantage is any quality that enables a company to offer similar products to its peers while enjoying superior financial performance. Over time, companies are more likely to lose their competitive advantage because, as they grow increasingly profitable, competitors are more likely to replicate their methods or create even better ones. As soon as the level of a company's profits is significant enough to warrant attention, it opens itself up to attack from competitors who are looking to enter the marketplace with the intention of grabbing a share of those profits for themselves. This is exactly where a wide economic moat offers the protective barrier a business needs to prevent other companies from stealing its earnings. Or in other words, establishing economic moats can help companies protect their long-term profits. In reality, an economic moat serves as a competitive advantage over other companies within the same industry. But what sets it apart is the fact that the advantage is sustainable over a very long period of time. While these moats can be created in a number of different ways, and may be either narrow or significantly wide, it only stands to reason that the more of them a business can build, the better off it will be. Let me ask you a quick question. How can you feel confident about estimating a company's ability to generate earnings down the road if that ability is not protected in some way? Sustainability is the key to consistent and ever-growing revenues, and the economic moat is the key to that sustainability. While having a competitive advantage may allow a business to temporarily outperform its competitors, the economic moat is a benefit that's built to last, and it will ultimately determine whether a company is set up for prolonged success or inevitable failure. From an investment point of view, the longer a company's economic moat can hold firm, the longer you will benefit from its profits. It's important to be aware that there are some false business moats in the marketplace, masquerading as the real thing, and you should be careful not to be taken in by these imposters. Features like superior products, outstanding marketing strategies, and high-performance management teams are all wonderful attributes for a business to have. But on their own, they are not enough to provide a long-term competitive advantage. products and marketing tactics can easily be copied, and so require the presence of a deeper, more durable barrier to support and protect them from would-be thieves. So make sure that you'll only invest in companies with moats that generate superior shareholder returns over the long run. And you should also be extremely selective and focused on wide moat stocks. Although economic moats tend to be more qualitative than quantitative in nature, there are a number of ways you can recognize when a company has one or more in place. A significant amount of cash flow and a strong operating performance are common to all businesses with an effective economic moat. But here are 5 other factors that play a vital role in the establishment of a sustainable competitive advantage. In this module, we'll talk about cost advantage, efficient scale, intangible assets, network effect, and switching costs, and how a company can utilize these wide moats to gain the upper hand over their competitors. In the next video, we'll talk about the first one, which is the cost advantage. Okay, see you in the next video. In this video, we'll talk about the advantage of having lower costs. A business that has the ability to sell its goods or services for less than its competitors will have a distinct competitive advantage in the marketplace. Naturally, the only way to accomplish this and still earn a profit over the long term is to be able to manufacture a product or provide a service at a lower cost than everyone else. This is often the case for larger companies with the resources to buy in bulk or to operate more efficiently for a lower cost, and also for those types of businesses that can be effectively located close to both the source of their income and to their customers, such as in the case of a local quarry. And here's a quick note. You'll want to look for companies with a cost advantage that competitors cannot replicate. Remember that an economic moat should be something that's sustainable and cannot be easily duplicated. This means that if you want your company to have a sustainable competitive advantage, you must make it hard or impossible for your competitors to copy your methods. Similarly, companies can do this by developing and patenting new technology before their rivals. So that's why when evaluating a company, you should also spend some time reading its quarter and annual reports to see if they invest any money in R&D. Companies with significant cost advantages can undercut the prices of any competitor that attempts to move into their industry, either forcing the competitor to leave the industry or at least impeding its growth. And companies with sustainable cost advantages can maintain a very large market share of their industry by squeezing out any new competitors who try to move in. You now understand the cost advantage. In the next lecture, we'll talk about the size advantage. See you in the next video. Besides having a cost advantage, a company can gain the upper hand over their competitors simply because it's bigger. Sometimes the sheer size of a company, in conjunction with the small size or niche-like nature of the market it serves, is enough to deter potential competitors and to serve as a wide economic moat. At a certain size, a company achieves economies of scale. This is when more units of a good or service can be produced on a larger scale with lower input costs. This helps reduce overhead costs in areas such as production, financing, advertising, etc. Big companies that compete in a given industry tend to dominate the core market share of that industry, while smaller players are forced to either leave the industry or occupy smaller niche roles. When a company has a relatively exclusive monopoly, for example, it means it controls the supply of a particular product or service within a certain location or industry. This makes it very difficult for similar companies to get a foothold in the same market, since the established giant in the neighborhood has already claimed most of the available customers and has sufficient size and resources to do whatever it takes to hang on to them. In addition, when a company is big and it has lots of cash flows, it's much easier for it to grow by simply acquiring other businesses. A good example is Apple. For example, if Apple wants to develop a new headphone product line that will be used for upselling and increasing their lifetime customer value, they simply go out there and buy an excellent headphone business. And yes, they actually did. Apple bought Beats in 2014 for over $3 billion. And now they have great headphone products to sell in their stores, without spending too much time and effort building them. You know, it may take Apple's competitors years to build the same headphone business. And of course, they'll have to do a lot of work. By having a size advantage, Apple is clearly doing better than its rivals. So, as a value investor, you'll want to invest in companies with a size advantage. In the next video, we'll dive into how a company can create an economic moat with its intangible assets. See you in the next video. Okay, in this video, we'll talk about the possession of unique assets. Another type of economic moat can be created when a company invests in developing and building its own intangible assets. Examples of such assets include things like patents, a strong and widely recognizable brand name, copyrighted intellectual property, and specialized permits or other kinds of government-issued licenses. These types of assets provide a natural economic moat for the company's continued and profitable business operation. Strong brand name recognition allows these types of companies to charge a premium for their products over other competitors' products because they offer customers something that's limited, exclusive, or difficult to replicate, as well as something that's often known for having a predictable level of quality. The perfect example might be Nike, which started out as a simple athletic apparel company but has since become a major cultural institution and a purveyor not only of gear but of status. Designer fashion labels have similar business models, using their prestige to sell clothing for prices several times higher than the cost of production. Not only does intangible assets help a company survive in the long run, they also help prevent other competitors from duplicating the company's products because they are protected by copyrights and patents. In addition, I want you to take note of this. Popular brands aren't always profitable brands. If a brand doesn't entice consumers to pay more, it may not create a competitive advantage. That's a red flag telling us that the management is not doing a good job to increase the business earnings and cash flow. From an investor's perspective, a popular brand means nothing to me if it's not profitable and if it doesn't show any promise for future growth. As an investor, what we care about is how we can make a return on our investments. If a business is not profitable, our investment won't be profitable, and we'll likely take additional risks of losing our money. So make sure you pick your stock wisely. In summary, you should look for companies that are protected by the advantage of a premium brand name, a tightly licensed product, a loyal customer base, and an industry with extremely regulated and complex entry requirements. And you also want to make sure the company's management knows how to utilize these intangible assets. In the next video, I'll talk about the network effect, which is another way an economic moat can be created. Okay, see you in the next video. In this video, we're going to talk about the benefits of the network effect. When a business has the built-in ability to both grow and improve as it gains more customers, it is said to benefit from the network effect. In these cases, the more people who use a certain business, the bigger its market share gets. But more importantly, the more exclusive its hold on that share becomes. This is simply because having more users translates into a more valuable product or service for all, and inherently leads to a never-ending cycle of continuous growth. The network effect is an extremely powerful type of competitive advantage, and it's most often found in businesses based on sharing information or connecting users together. You don't see it much in businesses that deal in physical goods. Examples of this can be seen in companies such as eBay, Visa, and Facebook. The more people who use these particular services, the better the experience becomes, which leads to more people using the services. The network effect gives a company a lot of advantages over its competitors. Looking at Facebook, for example, Facebook becomes more and more profitable when more people use it. You know what? Facebook has access to a database of billions of people around the world. So this means they can easily make billions of dollars just by utilizing their customer base. You see, the network effect makes it hard for other companies to compete with Facebook, because if they want to enter a competition, they must spend a lot more money on advertising and a lot more effort on reaching more people and showing their products. In the case of Facebook, they can reach billions of people without any hassles. You can guess who will win in this game. This competitive advantage can be difficult to dislodge once it gains momentum, and so it offers a potentially enormous economic moat to the lucky company or two that managed to establish the first successful networks in a particular industry. So make sure that you'll look for companies with a strong network effect. They are always winners in their industry. In the next video, we'll talk about how a company can create an economic moat by commanding high switching costs. Okay, see you in the next video. Okay, the final way a company can go about building a sustainable competitive advantage is integrating high switching costs into their business. Switching costs are expenses or disruptions a customer will encounter when switching from one product or service to another. It's beneficial for companies to create high switching costs, as doing so can help them retain customers. Cell phone service providers, for example, can lock in customers because of their high switching costs. To change providers, a customer might need to terminate an existing contract and purchase a new phone, both of which can be costly. As such, customers might be less motivated to switch providers even if they're dissatisfied with their current service. You see, how well a company is doing is determined by its ability to maintain its customer and supplier base, regardless of how fierce the competition is. When a company provides a customer with a product or service that is difficult to break away from, in terms of cost, time, or convenience, it's far more likely to hold on to that customer over the long term. And this makes competition more interesting, because if the company's competitors want to gain more market share, they must offer an extremely attractive price or performance alternative to entice consumers to switch from their current provider. Their competitors will have a very difficult time taking market share away because of these cumbersome switching costs. In many cases, customers just aren't interested in dealing with the fees or aggravation involved in making the switch, regardless of how appealing a competitor's offering is. Not only does this fact allow the company to maintain a strong customer base, it even makes it possible for them to incrementally raise their user prices over time, in order to consistently increase their profits. That is to say, when a company is able to establish itself in an industry, it can have higher pricing power over its competitors, and this is something that will help it survive over the long run. So, as a value investor, make sure you'll look for businesses that are industry leaders, and they know how to integrate high switching costs into their operating and marketing practices. In this video, we'll talk about the complete value investing roadmap so you'll know exactly your next steps and what you'll need to do to become a successful value investor. As you've already learned, by implementing the value investing strategy, you'll need to follow these 3 simple, easy steps. First, we'll look for companies with a strong financial and operating performance. What we want to do as a value investor is to make sure that the company we're investing in has enough capacity for maintaining its operations profitably, as well as having an ability or strong economic moat to compete with its rivals in the same industry. You can evaluate if a business is financially strong or not by looking at some financial ratios and performing a financial statement analysis. You'll need to look into your company's balance sheet, income statement, and cash flow statement to find out what's behind the numbers. And when you found a solid company, the next step is important. You'll need to make sure that it's undervalued. You can easily determine if a stock is undervalued or overvalued by performing a stock valuation based on some method like the discounted free cash flow model. After estimating a company's intrinsic value, you simply compare its intrinsic value with the current market price. If the intrinsic value is greater than the current market price, the stock is considered undervalued. And on the other hand, when the intrinsic value is lower than the market price, the stock is overvalued. It's simple as that. And always make sure you'll apply a margin of safety to make sure that you'll actually buy an undervalued stock. However, knowing a company's intrinsic value is not enough. That's because you'll need to find the best opportunity to buy it. A great company can easily end up being your worst investment when you buy it at the wrong time. And that's why technical analysis is essential in your value investing system. By utilizing technical analysis, you'll know exactly when to buy your stock to maximize your profit while reducing your risk. And the final step is sell your stock when it becomes overvalued. Again, you can determine the best time to sell for maximum profit by using both stock valuation methods and technical analysis. So that's the 3 simple steps you'll need to follow. Now, let's talk about the roadmap for mastering the value investing technique. I've been a value investor for 7 years now, and here's what I've learned to become a master. To become a profitable value investor, first and foremost, you'll need to learn all the best value investing strategies to find solid and financially strong companies to invest in. That is to say, you'll need a system. You'll need a set of investment criteria for evaluating and picking undervalued stocks. By having a system, you can make sure that all the companies you choose are rock-solid companies, and you can easily automate your stock analysis and valuation process. You can either build your own system or simply follow our copy and paste value investing system. After knowing all the strategies that actually work, you'll need to enhance your expertise so you can understand better all the businesses that you're investing in. You'll need to learn more about financial ratios and how to read and analyze a company's financial statements. If you were an accounting or finance student when you were in college, you might have gotten familiar with these topics. But if you're not a finance person, learning these topics may be a little bit harder for you. But they are essential if you want to be successful as a value investor. So learn it well. Next, you'll also need to learn more about stock valuation. At least you should master how to use the discounted free cash flow model, so you can project future cash flows of a company and estimate its intrinsic value. And when you're done with the intrinsic value, things will become much easier. Your next step is to use technical analysis to determine the best time to buy and sell your stocks. By using technical analysis, you simply look at a stock's chart and determine current market trends and predict the future movements of your stock. You'll need to look at some technical indicators and oscillators like the moving averages, the RSI, the Bollinger Bands, volume, the MACD, etc. And you can also look at chart patterns and candlestick patterns so you can predict if your stock's price will go up or down in the future. And the final thing, you'll need to develop a strong winning mindset and learn about trading psychology. You'll also need to know what affects the price of your stock, how to trade at minimal risks, how to reduce risks on your investments by placing a stop loss, etc. So, that's everything it takes to become a profitable value investor. You know, value investing is a big subject, and it does require some kind of expertise, a lot of work, and patience. But you know, value investing will eventually pay off. I promise you that. Imagine you can grow your investments by at least 15 to 25% a year by just following a simple system that you can create on your own. That's much easier than putting your money somewhere else, like in the bank or your 401k and IRA that generally pay you nothing in return, or a small fraction of the return you could have made. So, welcome to the value investing world. I believe you can do whatever it takes to become a better investor, and you can change your financial future.
Hi everyone, I'd like to welcome you to this Wealthy Education Technical Analysis Trading course. I'd like to walk you through a little bit of what we have in store in the course for you. So without further ado, let's get into what the course is about. First, we'll walk you through how to read a stock chart. We'll talk about some technical indicators, how to use those to increase your trading probabilities, and combine them with other indicators and chart patterns. We'll also look at a few technical oscillators, what exactly those are, how they're designed, and what they tell you about where a stock is headed, whether it's in an overbought or oversold condition, and whether the oscillator sees a turn in the trend the stock is in. We'll look at a few chart patterns. We'll look at some continuation patterns that give us an opportunity to buy into a stock that's already in a bullish trend, or perhaps short a stock that's in a bearish trend. We'll also look at candlesticks and a few candlestick patterns, including how to read a candlestick and what the candlestick is telling us. Combined with all of these, we'll talk about trading psychology, what all of the indicators and patterns tell us about what investors are thinking when we see price movement in a stock, and how being able to read investor psychology, especially around support and resistance levels, can add a lot of percentage points to your trading. As we go through the course, as I said, we'll talk about analyzing a stock chart. We're going to talk about line charts and bar charts and candlestick charts. We'll talk about how to use support and resistance and how they can set you up for entry and exit points in a stock, which give you a high probability of winning. We'll talk about how to use the technical indicators and oscillators to predict both upcoming trends as well as continuations in trends and trend reversals. And we're going to talk about chart patterns and how those can also help you identify trend reversals and trend continuations. With each of the items that we cover, we'll show a real-world example on a chart so that you can see how to use the indicators or how to read the chart patterns and apply them in your trading. So with that, and I'd like to welcome you to this course, and I'll see you inside. The information presented in this video is provided by Wealthy Education and is for educational purposes only. Nothing in this video or this course is intended as a recommendation to buy or sell any security. Welcome to this course on technical analysis. Today we're going to be talking about how to read a stock chart. It's important to get the basics down because we'll be using these basics throughout the course. So let's talk about stock charts. There are a variety of types of stock charts you can use, and we'll be looking at some real-world examples in just a moment. Some of the types include a line chart, a bar chart, and a candlestick chart. I'll show you the line chart and the bar chart as well as the candlestick chart, but throughout the course we're going to be using candlesticks as our main charting tool. And in just a second I'll go over the graph on the left to describe how a candlestick works. A stock chart shows a daily, hourly, or weekly, or by the minute movement of a stock and provides the open, high, low, and close for the time period. So if you're looking at a daily chart, then each bar or candlestick is going to represent one day. If you're looking at an hourly chart, then each of those would represent an hour on the chart. A line chart, which we'll see in just a minute, gives the closing price for the time period you're looking at. So if you're looking at a daily chart, it'll give you the closing price for the day. Charts are important because they allow you to determine if the stock is in an uptrend, a downtrend, or a consolidation pattern, which basically means moving sideways between two prices. So let's talk a second about the candlesticks on the left. We'll have two types of candlesticks, a red candlestick and a green candlestick. And these will be the predominant candlesticks on a candlestick chart. You can have a candlestick which is neither red or green, which basically means the stock opened and closed at the same price for the day. Let's talk about the design of the candlestick. You'll have a green or red body, which is shown here. That's the body of the candlestick. And then you'll have a wick. You can have a wick on the top and a wick on the bottom of the candlestick. Each of these is a wick. So for our green candlestick, the top point of the wick is the high price for the stock during that time period. And for this example, I'll use a daily time period. So this is the high price for the day. The high part of the green body is where the stock closed for the day. The low part of the green body is where the stock opened on the day. And then the low part of the wick beneath the body is the low for the day. The red candlestick is very similar. The high part of the wick on top is the high for the day. But with a red candlestick, the stock has opened in the body at the top of the red body, and it closed for the day at the bottom part of the red body. The bottom wick represents the low price for the day. And we'll see candlesticks over and over on the charts. So if you're a little confused right now, that's okay, because we'll be going over these quite a bit. So let's take a look at a couple of stock charts where I can show you the line chart, the bar chart, and the candlestick chart, and also show you what a trend looks like in a stock. Throughout the course, we're going to use tradingview.com to show charts. So I'll show you how TradingView works and how we can look at various charts using TradingView. In the upper left corner, we'll put in the symbol for our stock. So here we've typed in BAC. BAC for Bank of America. You can choose the stock from a drop-down list. The next box over gives us our time frame. So in this case, we're looking at a daily chart. We can look at a chart by the minute, by the 15-minute, 45-minute, hourly, daily, weekly, and monthly. As I said, here we're using a daily chart. The next box over tells us the type of chart that we're going to be looking at. So we're first going to look at a line chart, and the line chart gives you the closing price for the day. If you look at the top of the chart, it will tell you on the day that you're looking at what the open, the O is the open, H is the high, and the prices are changing because as I move the cursor, it's moving from day to day. The low for the day and the close for the day. So if we pick a day, we can look at the bottom of the chart. It'll give us the day. So on July 13th of 2018, the stock opened at 28.62. The high for the day was 28.69. The low for the day was 28.22. And the close for the day was 28.55. This will be true on all the types of charts we look at, on the line chart, the bar chart, and the candlestick chart, that it will give you the day at the bottom and the open, high, low, and close at the top. So now let's look at a bar chart. I'm going to zoom in a little bit so we can see the bars. So if we look at the bar chart, is in two different colors, red or green. The red shows a down day and the green shows an up day. On the left side of each bar will be the open price. You'll see the horizontal bar, which represents the open price. On the right side is a horizontal bar that represents the closing price. Just like with candlesticks, the high of the day is represented by the top of the bar chart, and the low of the day is represented by the bottom of the bar chart. So on this day, August 13th, 2018, the stock opened at 31.08, which is the horizontal bar on the left. The high was 31.12, which is the top of the bar. The stock closed at 30.48, which is the horizontal hash on the right side of the bar. And the low for the day was 30.45, which is the bottom of the bar. Now let's take a look at candlestick charts. And let's look at that same day on the candlestick chart. Here on August 13th, everything is the same, the open, high, low, and close. You can see there's a very small wick at the top, which represents where the high of the day was. A very small wick on the bottom. The stock opened at 31.08, as we said, and that's the top of the red body, and it closed at 30.48, which is the bottom of the red body. Now let's take a look at a green candlestick. Let's look at August 31st. We'll see that the stock opened at 30.88. It dropped down to a low of 30.62. It reached a high of 30.95 on the day, and then closed at 30.93. And you can see that the close and the high are very close to each other, so there's almost no wick. You really have to zoom in to see a very tiny wick at the top. So that's how we read a candlestick on a chart. Now let's take a look, again using Bank of America. I'm going to zoom in, and we'll look at some trends in the stock. At the beginning of this chart now, in November of 2017, we have an uptrend in the stock. I'm going to draw a trend line here. So we have the stock moving up in an uptrend. Then the stock moves in a consolidation pattern. And I'll draw a support line. And don't worry, we'll talk about support and resistance in our next video. And a resistance line here. So basically the stock trades sideways in a consolidation pattern. The stock then moves into another uptrend here. And then this is followed by a downtrend when the stock is falling in price here. So here we have a couple of different uptrends. At the beginning of the chart, we have an uptrend as the stock moves from $26 or so to around $32.50. A consolidation pattern as the stock moves from $31.50 to $29. The prices are all shown on the right-hand side of the chart here. And as we move the mouse up and down, you can see the price change. We then have an uptrend here, again as the stock moves to around the $31.50 and $32 level. And then a downtrend as the stock moves from $31.50 back down to the 26 level. So that's how we read a chart in TradingView. That was an example of a line chart, a bar chart, and a candlestick chart. An uptrend, a consolidation pattern, and a downtrend in Bank of America. Thank you for watching this video on how to read a stock chart. In our next video, we're going to be talking about support and resistance, which are two very important concepts in technical analysis. I look forward to seeing you in the next video. Thanks. Hi everyone, and welcome back to this wealthy education video on how to use support and resistance. Support is a price which a stock trades down to and then generally moves up in price. If you look at our graph on the left, the stock has moved down to this support level and is now trading or bouncing up off of support. The stock then trades up to what is called a resistance level, and that is a price which a stock trades up to and then generally moves down in price. And then the stock trades back down to the support level, where it will generally move up in price from that level. And I say generally because a stock will go through both support and resistance. And this can happen on a fairly regular basis. But we can use support and resistance to provide sell and buy signals in our stock. They provide areas where there is a higher percentage chance that the stock will move either up or down, depending on whether it is at support or resistance. A break of support or resistance may signal a strong move in the continued direction of the break for the stock. So a break through support may indicate that the stock is going to move down, and a break above resistance may indicate that the stock is going to move up. The longer a support or resistance level is in place, the more important the signals that the support or resistance level provides. So a multi-day support level is more important than a multi-hour level, and a multi-week level of support or resistance is more important than a daily level of support and resistance. You can have both major and minor levels of support. The major would be at the higher time frame and in place for a longer period of time. And then you can have minor levels of support and resistance in shorter time frames. Or these can be set up within major levels of support and resistance. So let's look at support and resistance on a chart. We're going to start with a chart of Intel. And here I've entered INTC in the upper left portion of the chart. It's a daily chart. We're using candlesticks. And I'm going to draw a support and resistance level at the beginning of this chart. Here we have a resistance level. And here we have our support level. And as we can see, the stock traded in this range between resistance and support for more than a year. This is September of 2016, all the way up through September of 2017. This is an example of how important it is when a long-term support or resistance level is broken. So when the stock broke through this resistance level, right around $38, you can see the stock then made a huge move to the upside, eventually reaching right around $57. So the stock had been trading in this range or consolidating for over a year. And when the stock broke through resistance, it made a large move. One of the reasons stocks make large moves when breaking support or resistance is because the stock is doing something that most investors do not expect. At a resistance level, you expect the stock to turn back down and move lower. And at support level, you expect the stock to bounce or move up off of that support level. When a stock breaks through a resistance level, investors that have sold the stock at this level, thinking that the stock is going to go down, now must re-enter the stock, causing it to move up. And the same thing with a break of a support level. Now let's take a look a little closer in time. So we're going to use multiple time frame analysis to look at how we might want to trade Intel today if we were going to enter the stock. So we have those support and resistance levels in the past, and now the stock is trading higher. So we have a support level just above 42 that we'll draw in, and then we're going to zoom in to an hourly chart. And here we can see that there are support and resistance levels on the hourly chart as well. Right around 49 is our resistance level, and our support level remains here just above 42. This is our major support level. If we zoom out, we'll see that this is a minor resistance level. And we'll go back to a daily chart. And we see the minor resistance level as the stock is bouncing up in a downtrend. Our major resistance level at this point would be the high that the stock reached just below 58. So there we have an example of a major and minor resistance level early in the chart. We saw a break of the resistance level and the stock move up strongly to this 58 level. We now have a major support level in place just above 42, which the stock has touched several times in early 2018 and in October of 2018. And we have a minor resistance level right around 49, where the stock has bounced up to after touching support just above 42. So that's an example of support and resistance in the stock of Intel. In this video, we talked about resistance and support levels that we could draw horizontally. And those work well when a stock is not moving in an uptrend or downtrend, but in a consolidation range. In our next video, we'll talk about an exponential moving average, which is a way to draw a support and resistance level when a stock is trending either up or down. I look forward to seeing you in the next video. Hi everyone, and welcome back to this Wealthy Education video on how to use exponential moving averages. The exponential moving average, as we talked about at the end of our last video, can give us a support and resistance level to trade stocks that are moving up in an uptrend or trending down. So let's talk about the exponential moving average. A simple moving average is calculated by adding together prices in a given time frame and dividing by the number of time frames. So a 20-day simple moving average would take the closing price for the last 20 days, add them all together, and then divide by 20. The EMA, or the exponential moving average, is calculated in the same way, except the closer in time frames, so the closer days are given more weight than further out days. So yesterday's closing price would be given more weight than the day before, which would be given more weight than the day before. We can use EMAs in a couple of different ways. We can use an EMA as a support or resistance indicator, or we can use two EMAs with different time frames to get an indicator that will give us a buy and sell signal. And I'll show that to you on a chart in just a moment, but we'll have a fast line, which will be represented by the lower number of time frames, and we'll have a slow line, which will be represented by a higher number of time frames. So for example, we could have a 20-day line, which would be our fast line, and a 50-day line, which would be our slow line. You'll hear of two particular types of moves with an EMA. One is called the golden cross, and the other is called the death cross. The golden cross is when the 50-day exponential moving average crosses above the 200-day exponential moving average. And the death cross is the opposite. It's when the 50-day EMA crosses down below the 200-day EMA. And these are two types of crosses that are paid particular attention to with the S&P 500 or the Dow Jones Industrial Average. But they can also come into play in individual stocks. So let's look at the EMA on a stock chart. Let's use a chart of Wells Fargo to demonstrate how we will use the exponential moving average. So we type in WFC in the upper left, and that gives us Wells Fargo. We move over to indicators, type in EMA. It comes up as moving average exponential. We're going to click that, go to format, and we're first going to look at the 50-day exponential moving average. So we hit OK, and this brings up the 50-day exponential moving average. With the exponential moving average, we want to be short or not long the stock when it's trading under the exponential moving average, and we want to be long the stock when it's trading above the EMA. So if we start at the beginning of the chart, we see the stock is below the 50-day exponential moving average, and it's in a downtrend. And I'll add a downtrend line here. And it's below the EMA. So we'll use the EMA as our support and resistance level. When the stock moves above the EMA, as it does here, we would get long the stock. The stock moves from 54 to around the 56 level, comes back and closes below the EMA, moves back again, positive through the EMA, and then comes back through the 50-day EMA again to the downside. So we may have taken a couple of trades here that were losing trades, or we did not make very much money on these trades. And then the stock moves above the EMA again here in June. Closes above the EMA in July, so we're still above, we're still long the stock. And we get a move from around the 55 level up to around 59 before the stock gives us a sell signal here in September, and then Wells Fargo moves to the downside. So we can see in the uptrend, the stock is generally above the EMA, and then as the stock crosses to the downside, we get a downtrend in the stock. So that's how we would use a single EMA to give us a signal as to whether the stock is moving up or down. Now, let's change our EMA. We're going to go to Format again, and we're going to use a 10-day EMA, which is going to be our fast line. We're going to add another EMA. So go back to Indicators, type in EMA again, click on Moving Average Exponential, and for our second EMA, which is going to be blue, we're going to make that a 20-day EMA. Here we see the 10-day crossing the 20-day and giving us our buy and sell signals. Here, where we marked it earlier, we have the 10-day moving above the 20-day after the stock had been in a downtrend. It stays above the 20-day until June. We get a cross to the downside, and then another cross to the upside as the stock is in an uptrend here. So by using two different EMAs, we get a little clearer signal as opposed to just using the single EMA by itself. And as we can see here, the 10-day crossing the 20-day to the downside would have given us a signal that the stock was moving into a downtrend, or that we would not want to be long the stock. If you want to generate more trade signals with your EMA, you can use a shorter time frame. So in this case, we're using a 10-day and a 20-day, but you can use a 5-day and a 10-day, and you would get more buy and sell signals. And if you want fewer buy and sell signals because you're trading on a longer time frame and you don't want to move in and out of the stock as regularly, then you would use a larger time frame. So you could use a 20-day and a 40-day, and it would give you fewer buy and sell signals in the stock. So that's how we use the single EMA as well as the combined 2 time frame EMA in the stock of Wells Fargo. Thanks for watching this video on the exponential moving average. In our next video, we're going to talk about the moving average convergence divergence indicator, which is a particular kind of exponential moving average, and how we can use the MACD to improve our trading. Thanks for watching this video, and I look forward to seeing you in the next video. Hi everyone, and welcome back to this Wealthy Education Technical Analysis course. Today we're going to be talking about the moving average convergence divergence, or the MACD. The MACD is a type of exponential moving average. It subtracts the 12-day exponential moving average from the 26-day exponential moving average to get one line, which is the MACD line, and then it combines this with a 9-day exponential moving average, as well as a 0 line that the MACD and the 9-day EMA can cross above and below. A cross by the MACD above the 9-day line is bullish, and a cross by the MACD below the 9-day line is bearish. A cross above the 0 line is bullish, and a cross below the 0 line is bearish. The crossing the 0 line is less important than the MACD crossing the 9-day line. When the stock price moves higher, as the MACD moves lower, we have a divergence. And this is a negative divergence. When the stock price is moving lower and the MACD is moving higher, then we have a positive divergence. A negative divergence tells us that the stock may cease to move higher and either turn down or move into a consolidation pattern. And a positive divergence tells us that the stock may cease to move lower and move into a consolidation pattern or possibly move higher. A cross in the MACD often indicates a trend change, especially if the MACD is in a bullish position well above the 0 line and then crosses the 9-day to the downside. This may indicate that a bullish trend is becoming bearish. And just the opposite, in a bearish trend, if the MACD is extremely oversold and the MACD then crosses the 9-day to the upside, this may indicate that the bearish trend is turning bullish, or at a minimum, turning into a consolidation pattern. So let's take a look at the MACD on a chart. Let's use a chart of ExxonMobil, XOM, on a daily basis to look at the MACD. So we're going to click on Indicators, type in MACD for the MACD, click the MACD, close this box, and then we have the MACD at the bottom of the screen. The center line is the 0 line for the MACD, and the blue line is the MACD line, and the red line is our 9-period EMA. Let's start at the beginning of the chart. We have the MACD in bullish territory above the 0 line, trending up, and then we get a cross of the MACD here, actually before the stock dropped off. So we had a cross of the MACD, which is in overbought territory at this point, to the downside, and then the stock drops. So with this cross, we may have sold our position or at a minimum tightened our stops and been prepared for a reversal in trend from a bull trend to, at a minimum, a consolidation pattern, but the stock actually went into a bear trend. The MACD drops along with the stock, and then we get another crossover of the MACD here. And this is a bullish cross of our blue MACD line above the red 9-day line. We get a short rally in the stock, but then the stock continues down here as the MACD continues up. So this is a bullish divergence in the MACD. We have the price of the stock dropping, the price of ExxonMobil dropping, and the MACD rising. So this should tell us if we're short the stock to tighten our stops and possibly look for an exit of our short and prepare to go long. The MACD crosses the 0 line, which is bullish. The stock moves up. We then have the MACD continuing in bullish territory. It's above the 0 line until a cross here, back below the 0 line. The stock continued to move up as the MACD was in bullish territory, and as the MACD moved below 0, we have the stock coming back down and breaking this support level. And then we have another buy signal in the MACD, which is an oversold, but not in extreme oversold position, as it was back in February. So with this buy signal, if we had taken a short position here, we'd be ready to exit that position and perhaps ready to go long, as the stock had almost touched a major support level here, dating back to May. So we have a major support level combined with a buy signal in the MACD, which again would have us exiting our short position and possibly taking a long position. The MACD confirmed by crossing the 0 line in early September, and the stock continued up from the $80 level to around the $87 level. We had another sell signal in our MACD, which was overbought at this point. So this sell signal would have told us to tighten up our stops, and then we see the stock fall off again, and now we're in a buy signal in the MACD right now. So that's the MACD combined with support and resistance in the stock of ExxonMobil. Thank you for watching this video on the MACD, or the Moving Average Convergence Divergence Indicator. In our next video, we're going to talk about the Relative Strength Index. I look forward to seeing you in the next video. Hi everyone, welcome back to this technical analysis trading course. Today we are going to be talking about the Relative Strength Index. So let's get right to the Relative Strength Index, or the RSI. The RSI is calculated in the following manner. RSI equals 100 minus 100 divided by 1 plus RS. And RS is the average gain in N periods. So if we're talking about days, then RS is the average gain in days minus the average loss in that same number of days. Usually the RSI is calculated on a 14-day period. You can change this time frame, but that is the standard N that we're talking about. RSI provides buy and sell signals when a stock reaches an overbought or oversold condition. RSI is an oscillator, meaning it moves between 0 and 100, and we use it as a trend reversal indicator. It's best to use RSI with other indicators, such as support and resistance, because you'll often find overbought or oversold conditions around support or resistance. So when RSI rises over 70, we're going to look to sell the stock, or at a minimum, we're going to look to tighten our stops and be ready for the stock to turn down. When the RSI is under 30, we're going to look to buy the stock, as the stock is in an oversold condition at that point. Some traders like to use 80 and 20 as opposed to the 70 and 30 level with RSI. So if you're a more conservative trader, you're going to look to sell a stock or, again, tighten your stops when RSI reaches the 80 level, and you're going to look to buy the stock when RSI dives under 20. We're also going to look for divergences, just like we did with the MACD. So we'll look for both positive and negative divergences. If the RSI is moving down and the stock is continuing to move up, we have a negative divergence. And if RSI is moving up and the stock is moving down, then we have a positive divergence. Let's look at RSI on a chart and see how we would use it in our trading. Let's use a chart of Tesla to look at the relative strength index. So here we have Tesla, TSLA, which is typed in the upper left portion of our TradingView screen. We're looking at a daily chart, and we're going to go to Indicators and type in RSI. We see the relative strength index. It places the relative strength index at the bottom of the screen. And we can see in mid-June that the RSI gave us an overbought indicator. This line represents the 70 level. The RSI went through 70 and actually went up to around the 78 level. So this was giving us a sell indicator, and we would either sell or tighten our stops if we are long the stock at this point, which had been in an uptrend here. And we see the stock, after the RSI gave us the sell indicator, sold off. The stock had been trading. It went to a high here of 373.73. And then in the sell-off, it went down to a low of 286.13. So that was a nice move down in the stock with the sell signal provided by the RSI. The stock bounced, and we got another sell signal on the RSI here when it touched 70. So on this strong move up in the stock, the RSI was telling you that the stock was overbought at this point. And again, we would either sell our position or tighten our stop at this point. The stock trended down, and we actually get a buy signal in early September. Here the RSI gives us a buy signal as it drops through the 30 level, telling us the stock is oversold at this point. And we get a nice rally in the stock from around 260 up to around the 315 level. So that's the RSI with Tesla. But let's zoom out a little bit. And what we'll see is that the RSI, if we draw in a couple of trend lines, we have support here around this level. We have resistance here, which the stock did move through, but then came right back through within a day or two in each case. So if we had used resistance and support along with our RSI indicator, that would have given us more confidence that the trades were correct at this point. RSI is an oscillator that is best used, if you can use, with a support and resistance level. So that's RSI combined with support and resistance in the stock of Tesla. I'd like to thank you for watching this video on the relative strength index. In our next video, we're going to be talking about a couple of reversal indicators, a double top and a double bottom. I look forward to seeing you in the next video. Hi everyone, welcome back to this Wealthy Education course on technical analysis. Today we're going to be talking about reversal patterns, and specifically the double top and the double bottom. A double top is when a stock trades up to a resistance level 2 times in a relatively short time frame, and a double bottom is when a stock trades down to a support level 2 times in a relatively short time frame. As you can see from the graph on the left, we have the stock in an uptrend. It moves up to a resistance level, has a pullback to a pullback low, moves up a second time to the resistance level, and then pulls back and dives lower than the first pullback low. So basically with a double top, you have sort of an M pattern, and with a double bottom, you're going to have a W pattern. And when the stock breaks out of the pattern, as it does here on the right side of this graph, and moves lower, that is your signal to either sell the stock if you're long or go short the stock. The psychology behind the double top is that the stock has traded up to resistance and has failed to penetrate higher, so the bulls have started to lose control. The stock has a pullback, and instead of rising and going through resistance the second time, which would confirm the bullish pattern, the stock peters out at the top a second time, showing that the bears are now in control of the stock, and then the completion of the pattern when the stock drops lower than the first pullback indicates a reversal in the bullish trend and that the bears are now in control of the stock. And the same is true for the double bottom, with the psychology being that the stock that has been in a downtrend is now reversing course because it has failed to break through a support level 2 times in a row. And now the bulls are taking control as they take it higher than the pullback high reached and the double bottom pattern. Let's see what this looks like on a chart. Let's take a look at a double top in the chart of Advanced Micro Devices, or AMD. We have the stock in a clear uptrend. It's moving up here. We have a pullback in the stock. And then another attempt to go through a resistance level, the high that has been set by the stock previously, and then a move down in the stock. As it breaks through this level right around 31, that's the point where we want to go short the stock. So you can see we have the M pattern. As the bulls are in control, they lose control and the stock pulls back. But if the stock were to continue higher here in late September and break above this resistance level, then the bull move would still be intact, but the stock doesn't. It pulls back. Now, if it were to hold this support level now and move higher, it would still be a buy and still be in the bull pattern. But the stock breaks through here in late September to the downside. And when the stock breaks to the downside, that's when we want to either sell our long position that we've held during this bull run, or we may want to go short the stock as it completes the double top pattern. So that's a double top in AMD reversing a bullish pattern with the stock now in a bear trend. Now let's look at a double bottom in the stock of Intel. The stock is in a bearish trend. It makes a bottom here right around the 33.5 level. The stock bounces higher. The W and M pattern do not have to be perfect. The stock then comes back, retests the low for a second time, and then finally moves higher, goes through the pullback high, and continues higher. It is at this point that we would have either covered short positions we may have had in the stock or go long the stock as it completes the double bottom pattern and moves higher to the upside. So that's a double bottom in the stock of Intel. Thank you for watching this video on the double top and the double bottom reversal patterns. In our next video, we'll be talking about another type of reversal pattern, the head and shoulders pattern and the reverse head and shoulders pattern. I look forward to seeing you in the next video. Hi everyone, and welcome back to this Wealthy Education Technical Analysis video. Today we'll be talking about reversal patterns, and specifically the head and shoulders pattern. So let's take a look at what a head and shoulders pattern is. In a head and shoulders pattern, a stock is in an uptrend, it reaches a high, pulls back, and then reaches a subsequent higher high. And at this point, the uptrend is intact as we're making higher highs and higher lows. The stock then pulls back a second time, attempts to make another high, and is only able to climb as high as the first high in the pattern. So it's now in the process of making a lower high after this second pullback, and then the stock continues to make a lower low when it breaks through the neckline of the pattern. And the neckline is the trough of the first two pullbacks. So what we have going on from a psychological level is that the stock is performing as it should, making a higher high and a higher low, but then that pattern reverses itself, and we have the stock making a lower high and then a subsequent lower low. This tells us that the bull trend has come to an end, and the stock will either move into a consolidation pattern or may move into a bearish pattern. The result is that the pattern looks like a head and shoulders, with the shoulders being the two lower highs and the head representing the highest high that the stock makes in the pattern. So when you break down the head and shoulders pattern, as I just said, it's the stock moving from a pattern of higher highs and higher lows to a pattern of lower highs and lower lows. So let's take a look at a head and shoulders pattern on a chart. Let's use a chart of 3M for our head and shoulders pattern. Here we see the stock is trading on a daily basis, and we see the stock making a new high here, continuing its uptrend. The stock then pulls back, rises higher. So this first high is our shoulder, and then we have a head here. The stock pulls back again to this level, attempts to rise, and our second shoulder, it doesn't get quite as high as the first shoulder, and then the stock moves down. Now in this case, the stock breaks the neckline, which is here. So we have our head and shoulders pattern complete, and then the stock rallies again, but it's unable to close above the high reached in the second shoulder. So our trade remains intact. If we're to go short the stock, we want to use the high of the second shoulder as our stop. And with the stock not having a close above this high, we would have maintained our short position, and then we can see the stock falls off, moving from this 80 level down to the 74 level. A perfect head and shoulders pattern is fairly rare in the charts, but as we can see, this pattern holds the psychology of the trade, where we're making higher highs and higher lows, and then the stock reverses to making lower lows and lower highs. And again, we can use that second shoulder as our stop, because that's our resistance level now with the stock. So if we take a short position at the neckline, we can use that second shoulder as a stop for our short position. A reverse head and shoulders is just the opposite. You'll have a stock in a downtrend. It'll make a low, rally back up, make a second lower low, which is the reverse head, rally back up, and then make a third low that matches approximately the price point of the first low, which would then be your second reverse shoulder, and then rally above the upside down neckline. And with that pattern, we would go long the stock or definitely cover our short position if we're short the stock, which has been in a previous downtrend. So that's the head and shoulders pattern in the stock of 3M. Thank you for watching this video on the head and shoulders pattern and the reverse head and shoulders. In our next video, we're going to move on to continuation patterns, and we'll be talking about triangles, flags, and pennant patterns. I look forward to seeing you in the next video. Thank you. Hi everyone, and welcome back to this Wealthy Education Technical Analysis Trading course. Today we're going to be talking about continuation patterns, and we'll be focusing on triangles, flags, and pennants. Triangles, flags, and pennants are continuation patterns in either an uptrend or a downtrend. Our graph to the left shows a flag continuation pattern in a bullish uptrend. The pattern represents a price consolidation with minor support and resistance levels. We can use these support and resistance levels as buy signals in the trend. If you'll remember, we talked about exponential moving averages and how we could use those as support levels to give us buy signals and sell signals in a trend. We can use triangles, flags, and pennants in the same way. So what we're looking for is the stock to pull back in a bull trend, and when the stock breaks the upper portion of the resistance within the triangle, flag, or pennant, that break can be taken as a buy signal for the stock. The same is true in a bear trend when the stock is trending down and then pulls up in the pattern to form a triangle, flag, or pennant. When it breaks the lower bound of support in that pattern, then that is taken as a signal to enter the stock on the short side. A flag, which is represented here on the graph, looks like a rectangle. A pennant looks like a symmetrical triangle, and a triangle looks like a triangle on the chart. And we can have both ascending and descending triangles. So let's take a look at triangles, flags, and pennants on a chart. Let's look at our first pattern, which is a flag pattern in the chart of Intel. Intel was trending up. We have the stock in an uptrend. And we see a pullback in the uptrend here. That's the upper bound of the flag. And here's our lower bound of our flag. After this 3-day pullback, on the 4th day, the stock breaks the upper bound or the resistance level of our flag and moves to the upside. This could have been our buy signal, or we could have purchased the following day after it was clear that the stock had broken this short-term flag pattern. The stock continued to move up from here, which is around the 25.5 level, up to around the 29.25 level before turning down. So this was a continuation flag and a bull trend in Intel, and gave us a buying opportunity when the stock pulled back. Now let's use the chart of Qualcomm to look at a pennant pattern. We have Qualcomm, and we're looking at an hourly chart, and you'll often see flags and pennants and triangles on hourly charts. They can help guide your trading on a shorter term basis. So if we look here in July, on July 18th, we see that the stock is moving up, has a slight pullback, and then continues the bullish pattern. And then for several hours, we have a pullback here and support here, which is around 50% of our green candlestick, which is also an important number. And here we have a pennant. So when the stock breaks out at the end of the pennant pattern, it moves up, comes back and holds the support level, and then moves up a little more. We then have the stock coming back and testing this support level, which we can continue to draw here, and then moving up, bouncing off support, moving up, bouncing off again before it finally moves up off the 58 level, back up to the 62 level and beyond. So our pennant ended up being longer term support on an hourly chart, which we could have used to keep us in a long trade until the stock finally made a move higher. So that's the stock of Qualcomm with a pennant pattern. Again, breaking out to the bullish side of this pattern, coming back, touching support several times, and then finally moving higher. Thank you for watching this video on flags, triangles, and pennants. In our next video, we will look at another continuation pattern, the cup and handle formation. I look forward to seeing you in the next video. Thank you. Hi everyone, and welcome back to this Wealthy Education Technical Analysis video. Today we're going to be talking about our last continuation pattern, and that is the cup and handle pattern. So let's get right into the cup and handle pattern. The cup and handle pattern is named cup and handle because the shape of the trading pattern of the stock looks like a teacup. You have a bowl-shaped pullback in the stock, and then a move back up, which forms the right-hand side of the cup. We then have a pullback in the stock. Ideally, it will be to around the midpoint between the lip of the cup and the base of the cup, but is often more shallow. And then we'll have a move up in the stock from the downward sloping cup. And when the stock breaks the downward slope, that is the buy signal for the cup and handle pattern. The cup and handle forms a resistance pattern because the lip of the cup on the left side and the right side is a resistance point, and then the handle looks like a flag pattern as the stock pulls back after touching resistance a second time. So psychologically, you've had owners of the stock who have been underwater as the stock pulls back into the base of the cup. When the cup gets back to the right-hand side of the lip, you're back at resistance. So the buyers who purchased there and have been underwater the entire time the cup has been forming are now selling the stock and pressuring it, which causes the handle of the cup, your flag pattern, as the stock moves back down from encountering selling pressure. And then you have a move out of the handle to the upside, which is your buy signal. As a secondary buy signal, you can use the resistance level, which is formed at the lip of the cup. So let's take a look at the cup and handle pattern on a chart. We're going to use the chart of AMD Advanced Micro Devices to look at a cup and handle pattern. The beginning of our cup is here. We have a pullback, and I've drawn a curve so we can see what the cup pattern looks like. The second lip of our cup is here. And then we have a slight pullback in a flag pattern. And ideally, we would want the handle to come a little bit lower into the cup, but the psychology is the same. The stock has hit the resistance level formed by the left side and the right side of the cup. When it touches that resistance level, you get sellers who purchased the stock back at the end of June and are now back to even, and they're selling here in October. This forces the stock down, and then we get a break of both the resistance level and the handle, as well as the resistance level for the cup overall. As we can see, once that resistance level is broken to the upside, the stock continues to move up. So we get a movement from $16 all the way up to around $25 for the high of the stock. If you'll remember, we talked about earlier that a support or resistance level that has been in place for a longer period of time usually gives you a bigger move than a support or resistance level that has been in place for a short period of time. With a cup and handle pattern, we're looking for a move that would equal the measurement from the base of the cup, which in this case was around $11, to the lip of the cup, which was around $16. So we're looking for a $5 move, the difference between 16 and 11, when the stock moves up. We actually end up getting a much larger move than the $5 that we get from not only 16 to 21, which would have been the $5 move here. And we see this stock encountered a little bit of resistance at this point. It was able to break through, retest this resistance level, and then move higher up again, as we talked about, to the $25 level. So that is the cup and handle pattern in the stock of AMD. I hope you've enjoyed this video on the cup and handle pattern. This is Stephen Adams, and I look forward to seeing you in future videos. Thank you. Hi everyone, and I'd like to thank you for taking this Wealthy Education Technical Analysis course. I hope you have enjoyed the course and it's been helpful to your trading and makes you more profitable. I encourage you to look at other Wealthy Education courses as we go over these topics more in depth and explore a variety of technical indicators and chart analysis tools. Thank you again, and I look forward to seeing you in the next course.
Okay, first of all, I want to talk about saving and investing. There's a number of financial mistakes that people make in their lives, and one of the most serious mistakes is that they don't understand saving and investing. Saving won't make you richer. Investing will. Now, let's take a look at this situation. For example, you're making $2,000 a month. You start working at age 25, and you decide to retire at age 65. So your working period is about 40 years. Assume that you won't have to spend your salary, your income, on anything, and this literally means you can save 100% of your income. So with the average income of $2,000 a month, if you keep working hard in 40 years and save all your money, you'll be able to make a maximum of $960,000. You would almost be a millionaire. But the fact is that saving 100% of your income is simply impossible. That's because you'll have to spend a lot on housing, food, apparel, transportation, your entertainment, your family's vacation, your children's education, healthcare services, Social Security, your insurance, charities, and a lot more. So with an average income of $2,000 a month, you will never be a millionaire. Okay, now let's take a look at another situation so you can see exactly how investing can help you get wealthy without any extra effort. Assume that your income is still $2,000 a month, but in this case, you decide to save a small percentage of your income, for example, $300 a month, to invest. Assume that you start investing at age 25 and continue to invest $300 a month until you retire at age 65. With an only 10% annual return from the stock market, you'll be able to turn your $300 investments into $1.6 million in 40 years. Let's compare that with the previous case where you have to work really hard and try to save all of your money in 40 years. As you can see, for the same number of years, and with small investments of only $300 a month, you can easily double your net worth, build a satisfying retirement, and retire wealthy with a millionaire status. So, how can we turn small investments of $300 a month into $1.6 million? We can actually do so thanks to the amazing power of compound interest. Compounding is the wonderful way in which you can earn money not only on the original amount of an investment, but on all of the money that original amount earns along the way. Money makes money, and compounding exponentially increases the amount of money your investment earns. How compound interest works is simple. Let's say you have an investment that gives you a return of 20% in interest every year. For example, you invest $100 in the stock market. So in the first year, your investment will grow from $100 to $120. This means you've made $20 in profit. Instead of taking out the $20 profit, you decide to keep investing it. So your investment is now worth $120. In the second year, your investment will continue to grow by 20%. This time, from $120 to $144. So, you'll make a $24 profit in the second year of investing. The key to compounding lies in the fact that returns on an investment are reinvested as they're earned. This is what differentiates the compound return from the simple return. If you keep reinvesting your money, you'll make more and more profits every year. If you start saving and investing $300 a month today and grow your investments by an affordable return of 10% from the stock market, you can easily build a net worth of $1 million or more. If you start saving and investing $1,000 a month today, and if you do it the right way, I guarantee you, sooner or later, you'll be a millionaire. And if you're making a lot of money, maybe you're running a business or you're having a good job, just try to invest as much as you can. If you save and invest $5,000 a month with the same rate of return of only 10%, you can turn your investments into $17 million in 35 years. In fact, the more money you save to invest, the faster you'll achieve your financial goals. If you think that 35 years is too long, just think about it for a second. Everything takes time, and no matter what you're doing, you cannot achieve great results overnight. Period. Looking at Warren Buffett, the world's most successful investor, he once said, "I made my first investment at age 11. I was wasting my life up until then." Warren Buffett's been investing his money for over 75 years. It took him 75 years to become the richest investor in the world. You know, it's totally worth it. As you can see, making money takes time, investing takes time, and creating real wealth takes time. So forget about how long you'll invest your money for. Just put in the work and start investing as early as possible. Now you see the importance of investing in creating wealth. You just need to invest a small percentage of your income, and you can build a more satisfying retirement, create a better financial life, and have an abundance to care for your family and accomplish your dreams. Interesting, right? So how can we achieve a risk-free 10% annual return from the stock market? To be able to do so, you must first see the bigger picture of the stock market. As promised, I'm going to share with you my profitable investing experience that's helped me consistently profit from the stock market. I learned this secret the hard way by experiencing a lot of mistakes and failures. And now I'm sharing it with you because I don't want you to make the same mistakes as I did. And more importantly, I want you to succeed. Okay, now let's take a look at how the stock market's performed in the last 30 years. This is the 30-year history of the U.S. stock market. As you can see on the screen, over the last 30 years, from 1986 to 2016, the stock market's value has increased by over 1,000%. For example, if you had invested in the Dow Jones 30 years ago, your investment would grow by more than 1,300%. This is just a simple estimation. In fact, your annual return would have been a lot higher than 1,300%. That's because you would have earned a lot more thanks to the compound interest, and you'd also received dividends from your investment. As you can see on the chart, the stock market's value went up and down over time. There were some years that the stock market's value went up, and there were some years that the market's value went down. But if you notice, over the long term, the stock market would always keep increasing in value. The profitable investing experience is that the stock market is very volatile in a short term, but in the long term, it will always keep going up in value. Still don't believe? Okay, now let's see the 5-year performance of the S&P 500 index. As you can see on the screen, the stock market was very volatile. Its value went up and down over time. And that simply means if you invest in the short term, you'll likely take more risks. When I first started, I only looked for short-term investments because I was not patient. I was clueless about what was going to happen, and that's why I failed and lost all of my hard-earned money. In fact, we have no idea about what's going on with the market. But if you notice, over the long term, the stock market will always keep increasing in value. If you'd invested in the S&P 500 just 5 years ago, you would have been able to grow your money by nearly 90%. That would have been an easy 17.8% return every year, just to buy and hold your investment. Still not a believer? Now let's take a look at some random companies. For example, Amazon. As you can see on the screen, this company's stock is very volatile. The stock price went up and down over time, and the price fluctuation range is somewhere between $50 and $200 a share. That is to say, if you buy and sell this stock without a real strategy, chances are you'll potentially lose hundreds or thousands of dollars in just a few days or weeks. Actually, we don't know what will happen next with the stock market, but if you notice, over the long term, this stock will likely keep going up in value. If you'd invested in Amazon 5 years ago, invest for the long term, you would have grown your investment by more than 200%. You could have doubled your money in just 5 years and made $500 a share in profit. You see, by knowing a simple truth, you can make almost all of your investments become profitable. That's why people who know how to invest are always richer and wealthier than people who don't know how to invest. Now let's take a look at another example, Visa. This company's stock price also went up and down over time, but over the long term, it would always keep increasing in value. If you had invested in Visa 5 years ago, you could have easily made over 50% return every year from your investment. Okay, another example, Google. Similar to Amazon, this company's stock is also very volatile. The price fluctuation range is somewhere between $50 and $200 a share. It would be really risky if you invest in this stock for a short term. You may lose a lot of money when the price fluctuates. But if you invest for the long term, you can easily eliminate the risk and make your investment profitable. 5 years ago, you could buy Google stock at about $300 a share, and now its value has grown to more than $800 a share. And this simply means if you'd invested in Google 5 years ago, you would have made over $500 a share easily and effortlessly. Okay, the next example, the Home Depot. Despite the fact that this company's stock price went up and down every day, its value would always keep increasing over the long term. If you'd invested in this stock 5 years ago, you could have easily made over 53% return every year from your investment. The same for Facebook. Even though its stock price fluctuated wildly over time, this company would keep increasing in value over the long term. If you'd invested in Facebook, you could have tripled your money in just 5 years. Okay, another example, Nike. As you can see on the chart, this company's value has grown by 146% in the last 5 years. If you'd bought and held Nike 5 years ago, you would have made a more than 29% annualized return from your investment. Still not a believer yet? Now let's take a look at another example, Papa John's International. This is a value stock that I've recently purchased. As you can see on the screen, even though Papa John's is a great company, its stock is very volatile. The stock price went up and down over time, but if you notice, over the long term, the stock would always keep going up in value. If you'd invested in this company 5 years ago, you could have grown your investment by over 400%. And this simply means you could have multiplied your money by 4 in just 5 years, without trying too hard to beat the market. Okay, one more example. TXRH, or Texas Roadhouse. This is a good company that I've recently purchased, and many of my students also bought this stock and made some good profits. As you can see on the chart, even though the stock price went up and down over time, the stock's value would always keep increasing over the long term. If you'd invested in TXRH 5 years ago, you would have been able to make over 46% return a year on your investment. And this simply means that you could have doubled your money in just 5 years without taking high risks or trying too hard. So, what can we learn from this experience? Investing in the short term simply means you'll likely take higher risks. If you want to really make money with your short-term investments, you'll have to master a lot of technical trading skills. And it's not easy at all. So if you have no experience in using technical analysis, you should avoid making short-term investments. Our profitable investing experience is that the stock market will always keep going up in value over the long term. So if you're looking for the easiest and most profitable way to make your money work for you, you may want to look for long-term investments. For example, you can invest in value stocks, ETFs, or some kinds of income stocks. If you have no idea about these types of investments, don't worry, because I've got you covered in the next video. The final key point to take away is that both stock markets and individual stocks share the same characteristics. So no matter if you invest in the whole stock market index or invest in a particular company, you can apply the same strategy to grow your money. Okay, one more useful tip. If you're new to investing, you can apply the 90-10 rule to get started. How this rule works is simple. You can invest 90% of your money in long-term investments to make sure that your money will be safe, and invest the remaining 10% in short-term investments to test the water. This way, it's much safer, because if you fail, you'll only lose a small amount of money. You'll have nothing to worry about, but everything to gain. By applying the same strategy that I've shared, you can easily turn your small investments of just $300 a month into $1 million in 35 years. It's a lot of money for no extra effort. Just save some money and invest it. With an average return of 10%, you can easily turn your $300 investments into $1 million in 35 years. However, if you can double your return, say you can make a return of 20% per year for the same number of years and for the same amount of money invested, you can build a net worth of over $11 million. And that also means that you can easily multiply your net worth by 10 just by doubling your compound return to an affordable 20% a year. Investing is exciting, right? Once you have a real strategy, you can consistently multiply your money. And that's why knowing how to invest can change your life forever. It is very easy to make a 10% return a year. All you need is patience. You just need to have enough patience to wait for your money to grow. However, if you want to double your return to 20%, besides being patient, you'll need real education and a lot of hard work. When it comes to investing, honestly, you can't succeed overnight, and there will be no shortcut. To be successful as an investor, you must first invest in your education. You'll need to learn real strategies, put those strategies into practice, and start letting your money work hard for you. So now you know exactly what you need to do to grow your money and create a better financial life. Here's what we're going to cover in the next video. Make sure you keep an eye on your inbox because we'll have a lot of interesting stuff to talk about. In the next video, I'll teach you exactly how you can instantly build 4 streams of passive income. You'll learn how to build your own investment portfolio. I'll also teach you exactly how to use money to make money and give you my best investing tips and a lot more. Glad you enjoy it here, and I'll see you in the next video. An average millionaire has around 7 sources of income. In order to achieve wealth, having multiple streams of income is important. But building multiple income streams is not an easy job. That's because most of your time is spent on maintaining your first stream of income. That's your job or your business. And it's even harder when you have to work long hours and get tired when you get home. It's not an excuse, but we're all human beings. We have our own limits and incapacities, and we cannot ignore the fact that our time is limited as well. That's why I decided to make this video, to show you the best and easiest way to grow your wealth safely and effortlessly. So, how can you easily create 4 streams of passive income? The answer to this question is simple. You just need to invest your money in 4 different types of paper assets. And if you do everything right, those investments will be consistently putting the money back into your pocket. You can increase your income without any extra effort, and you can easily make a lot of money while you sleep. Interesting, right? So, what are those paper assets? Now, I'll dive into 4 different types of paper assets that I've been using to multiply my money and create multiple streams of passive income. They are ETFs, or exchange-traded funds, value stocks, dividend-paying stocks, and REITs, or real estate investment trusts. In order to create 4 distinct sources of income, you just need to put your money into these types of investments, and then let them do all the work for you. Now, let me dive into each type of investment in turn so you can see exactly how you can use money to make more money. Okay, first of all, I'll talk about ETFs. So, what exactly is an ETF? ETF stands for Exchange Traded Fund. An ETF is simply an investment portfolio that contains various types of investments, such as stocks, bonds, or some kinds of funds. Normally, ETFs are designed to track the overall performance of a particular stock market or sector, a bond market, or even a real estate market. So when you buy an ETF, this simply means that you're investing in a diversified portfolio that includes a number of different investments. For example, you invest in DIA, which is often known as Diamond ETF. It's an ETF that's designed to track the overall performance of the Dow Jones Index. For those who don't know about the Dow Jones Industrial Average is a stock market index that consists of the 30 largest businesses in the United States. So when you buy this ETF, this simply means that you're investing in those 30 largest businesses. And the cool part is, your money will be diversified and invested into many different market sectors, such as financials, healthcare, technology, energy, consumer services, etc. And that's the reason why investing in ETFs is the best way for you to build your long-term wealth. You don't need to buy a lot of companies. By investing in a single ETF, you're investing in different businesses in different market sectors. Basically, ETFs are the same as mutual funds, or some kinds of index funds, but their expense ratios are much lower. For example, if you buy a mutual fund, you'll have to pay 1 to 5% of your return in management fees every year, while if you hold an ETF, you'll only have to pay from 0.01% to less than 1% in management fees. That is to say, investing in an ETF is 10 to 100 times cheaper than investing in a mutual fund. If you invest in ETFs, you can easily make a 10 to 15% return every year. It still requires some strategy, though. The fact is that not every ETF is worth investing in. Some ETFs come up with bad performance, high management fees, and a high level of risks. So you'll need some strategies or some kind of knowledge to pick the right investment for yourself. Okay, one more useful tip to take away before we dive into the next type of investment. Always make sure that you stay away from mutual funds and wealth management services. That's because buying an ETF is much cheaper, and you can easily manage your portfolio by yourself. There's no need to waste your money on any wealth management services. You are an investor, so do it yourself and take full control of your money. Okay, the second type of investment, value stock. I bet you've heard a lot about value investing. So, what exactly is value investing? Value investing simply means you buy something that's worth $2 for only $1. Well, not exactly, but you get my point here. Value investing means you buy a company when it's cheap or undervalued and then sell it when it becomes more expensive or overvalued. So, how do you know if a stock is undervalued or overvalued? To determine whether a stock is cheap or expensive, you'll need to estimate its intrinsic value. A company is undervalued when its intrinsic value is greater than its current market value. Intrinsic value is simply a real value or true value of a business, and market value is simply the price at which the stock is currently selling. So to put it simply, if the true value of something is greater than the price at which it's selling, this means it's cheap, undervalued, or underpriced. So when you buy a stock that's undervalued, there will be a high chance that its value will increase over the long term, and you'll make a profit. That's all value investing is about. Buy something that's now cheap and sell it later for a profit. Similarly, a company is considered overvalued when its intrinsic value is lower than its current market price. The fact is that not every stock is worth investing in, even if they're blue chip companies. If you frequently perform intrinsic value calculation, you'll find that 90% of companies you're evaluating are overvalued. There will be a very low chance that you'll make a profit if you buy these stocks. And of course, there will be a very high chance that you'll lose your money if you pick the wrong investment. Now, I'm not scaring you, but just like any other businesses, investing involves some kind of risks. But some of these risks are controllable and can be easily avoided if you equip yourself with enough knowledge. If you master the art of value investing, you can easily make a 15 to 25% plus return every year. Actually, when you do everything right, you can easily make 20% or more in just a few months, just like I and many of my students did. There are thousands of opportunities to make money in the stock market. There are thousands of stocks out there. So the only thing you need is a real strategy to pick the best ones to invest in. Okay, now I'll talk about the third source of income, dividend-paying stocks. Investing in dividend stocks is the easiest way for you to profit from the stock market. Dividend stocks are simply companies that pay good dividends to their shareholders and investors like yourself. A stock dividend is an amount paid out by a company, usually in the form of cash, to investors who hold shares of their stock. So investing in this type of investment is very easy, but profitable, because you just need to find a good company, put your money into it, and wait for it to put the money back into your pocket. Most companies pay dividends quarterly, so you can collect the money 4 times a year. Just invest in a stock that pays good dividends, forget it, and 3 months later collect the money without really putting in any effort. That's exactly what dividend investing is about. The most interesting thing about dividend stocks is that they're a hybrid investment. This means you invest once, but you can profit twice. Sounds interesting, right? Dividend stocks allow you to share in company profits while also retaining ownership of your investment. When you invest in a dividend stock, you can earn a 5% to 12% plus return every year, paid out by the company in the form of cash dividends. And because you own all the shares you bought, when those shares increase in value, you'll make more profits. Normally, a good dividend stock will potentially grow at 5% or more every year. So if you put your money into this type of investment, you'll potentially earn a 10% or more return on your investment every year without any effort. However, similar to ETFs and value stocks, not every dividend stock is worth investing in. Some lousy businesses tend to attract outside investors by offering a high dividend yield. So you'll need to evaluate them carefully to find out if they're actually a solid company. Okay, the last type of investment that we're going to talk about is REIT. REIT stands for Real Estate Investment Trust. A REIT is a company that owns multiple rental properties, such as office and apartment buildings, hospitals, shopping malls, hotels, resorts, and so on. Similar to ETFs, a REIT is more like an investment portfolio that includes many income-producing real estate. So when you buy a REIT, this simply means that you're buying a small part of the portfolio. And the cool part is, you don't need to have millions of dollars to become a landlord. By buying a single REIT, you'll become a part owner of many rental properties. REITs make a profit from renting out their properties, and they're legally required to pay out as much as 90% of their income to unit holders or investors like yourself every year. So investing in REITs will bring you a stable stream of passive income. And the more interesting thing is that your money is now diversified into the real estate market. Just like investing in dividend stocks, investing in REITs is very simple. You just need to find a good REIT company, put your money into it, and wait for it to put the money back into your pocket. Investing in REITs will potentially bring you a stable return of 6 to 12% every year. So, how can you start investing your money now? The first thing you'll need to do is to make an investment budget. You should save 10 to 30% of your current income to invest. You don't need to have a lot of money to start investing. You may start with small investments of just a few $100 every month and frequently add more money into your portfolio. The more money you save to invest, the more wealth you can achieve. In order to build your investment portfolio, you may allocate your money as follows. Put 40% of your money into ETFs. Invest 25% in value stocks, and the remaining 25% in some income-producing assets like dividend stocks and REITs. Investing in ETFs is very important because they'll bring you a stable long-term profit. Make sure that you'll invest at least 40% of your money in this type of investment. Investing in value stocks will help you grow your portfolio faster as well as maximize your profit. If you can master the techniques of value investing, you can easily double or even triple your money in just a few months. However, investing in value stocks is much riskier than investing in other types of investments. So if you're just starting out, you should not invest more than 25% of your money in this type of investment. Investing in income stocks like dividend stocks and REITs will bring you a good stream of passive income. This is the easiest way to profit from the stock market. You just need to find some good companies, put your money into them, and collect dividends. You can easily make a few $1,000s extra every year. You can use these earnings to supplement your own lifestyle, schedule a vacation for your family, save to buy some luxury stuff, do charity, or do whatever you want. Investing in ETFs will bring you a stable long-term profit. Investing in value stocks will help you grow your money faster. Investing in dividend stocks and REITs will help you create a good stream of passive income. Now, you have a robust investment portfolio. In order to get wealthy, you must find ways to increase your income. It's all about income, guys. You must create multiple streams of income. In this video, you've learned 4 different investment vehicles that you can use to grow your money. Investing in ETFs will bring you a stable long-term profit. Investing in value stocks will help you grow your money faster. However, they often come up with a higher risk and require a lot of expertise. And if you want to make easy money, investing in dividend stocks and REITs may be the best option for you. Okay, that's enough for today's lesson. Now you know exactly how to use money to make more money. You see, investing is easy, right? It's not rocket science. You can easily create an extra stream of income that you can use to improve your lifestyle or support your family. Make sure you keep an eye on your inbox because things are getting more exciting. In the next video, I'll share with you my simple yet powerful technical analysis technique that you can start using today to make over 20.31% return in just a few months. I'll teach you step by step how to set up the technical indicator and how to use it effectively to determine if a stock's price will go up or down in the near future. I'll also give you my best investment tips, such as how to choose the right stockbroker for yourself, how much money should you have to start investing, and a lot more. So make sure you don't miss the next video. Glad you enjoy it here, and I'll see you in the next video. First of all, I want to talk about how to choose the right stockbroker. Before investing in the stock market, you'll have to sign up for a trading account from a stockbroker so you can use that account to buy and sell shares and manage your portfolio. But the thing is, there are a lot of stockbrokers out there, and maybe you have no idea of which one is the best for you and your trading needs. You see, some stockbrokers offer a very good service, while some are lousy and they come up with many hidden fees. So I think the most valuable information for you is how you can find a good stockbroker who can help you make your investments. Okay, there are 3 important criteria that I always use to determine if a stockbroker is good for me and my trading needs. The first thing, they must be reliable. Remember, when you use a stockbroker, you'll have to deposit your money into their brokerage account. And this simply means that they'll keep your money and help you make investments on your behalf. So, when you give someone your money, they must be reliable and trustworthy. If you can't trust them, how dare you let them keep your money? When it comes to trading, having peace of mind is very important. That's because trading is very stressful, especially when you're a beginner. How can you make a good trade when you keep worrying about whether your money is safe? So first of all, you must start with a reliable stockbroker. Do some research and list all stockbrokers in your country. Find out the most popular and reliable ones, and eliminate all brokers that have many bad reviews and testimonials. The next thing that you should take into consideration is a trading platform. In order to trade effectively, you'll need a professional trading software that can help you perform technical analysis to predict the future movement of your stock. Normally, your stockbroker will provide you access to their trading platform for free. Some of them may charge a monthly subscription fee to their trading software and higher-level financial data. I prefer using the Thinkorswim trading platform from TD Ameritrade. It's an advanced trading tool, and the cool part is, it's completely free. You can easily sign up for a trading account from TD Ameritrade. You don't need to deposit any funds to open a trading account with them. After you have your trading account, you can use their professional trading software, Thinkorswim, for free. Besides TD Ameritrade, there are some stockbrokers that also provide advanced trading tools, such as Interactive Brokers and E-Trade. However, these brokers often require you to make an initial deposit to open a trading account with them. And the final thing you should care about is pricing. In my opinion, pricing is less important than the first 2 criteria, which are the reliability of a stockbroker and their trading platform. That's because as an investor, you need to make sure your money will be kept securely by a trusted broker. And you'll also need a professional, unbiased trading software to trade effectively. Normally, you'll be charged about $10 per trade. You see, the trading fee is not too expensive. Actually, if you can make money from the stock market, you don't need to worry too much about the trading fee. So make sure you'll always look for a reliable broker with a professional trading platform first, and then look at their trading fee later. Besides TD Ameritrade, my favorite stockbroker is Interactive Brokers. They're the cheapest but most reliable broker. You'll be charged just $1 for every 100 shares you buy. This broker offers a very good trading fee. However, to open a trading account with them, you'll be required to make an initial deposit of at least $10,000. Okay, my number 1 trading tip for you is that you can have 2 trading accounts. If you're investing in the U.S. stock market, you can open a trading account from TD Ameritrade and Interactive Brokers. The cool thing about TD Ameritrade is that you don't need to make any initial deposit to open a trading account with them. Once you have your trading account, you can use their trading platform Thinkorswim for free. You can use your TD Ameritrade account for analyzing stock charts, and use your Interactive Brokers account for buying and selling stocks. As I've mentioned earlier, using Interactive Brokers is very cost-effective because you'll be charged just $1 for every 100 shares you buy. In case you use other stockbrokers, you'll be charged about $10 or more. So by having 2 trading accounts from TD Ameritrade and Interactive Brokers, you can trade with a very low trading fee, and you have free access to the Thinkorswim trading software. Okay, the second tip. You should always stay away from cheap and unreliable brokers. Many first-time investors look for cheap brokers because these brokers offer a low trading fee. But they don't understand that low cost simply means low quality services. You'll get what you pay for. You see, cheap brokers are consistently lowering their fees in order to attract more customers and gain market share. Some even offer free trades. They offer you a low trading fee, but they'll charge you for accessing high-level market data and their trading software. And they often have a low-quality customer service. There will be a lot of hidden fees, and you'll get what you pay for. So make sure you always stay away from cheap and unreliable stockbrokers. And the next question that I think many of you have right now is, how much money should I have to start investing? In fact, you don't need to have a lot of money to start investing. You can start with $10,000 and then you can add $300 or $500 to your portfolio every month. It's okay to start investing if you don't have $10,000. Maybe you have $3,000 or $5,000 right now. However, you should take the trading fee into consideration. That's because trading and commission fees charged by your stockbroker will potentially outweigh your profits if you trade with a small account. I strongly recommend that you only invest when you have no debt and you have some money that you can afford to lose. And always make sure that you'll invest in your education first. You cannot succeed if you don't know exactly what you're doing. If you don't have $10,000 to invest now, don't worry. Just save up more cash and start investing later. After you open a trading account, you can frequently add more cash to your portfolio so you can take advantage of the compound interest to grow your money. And the final tip is that you should avoid making a trade on mobile. That's because mobile trading sucks. I agree that some mobile trading apps are convenient on the go, but the downside is that you can't analyze a stock's chart accurately. You can't use some technical indicators properly, and that will potentially lead to a bad investment decision. Sometimes you'll face some connection issues, so make sure that you won't make a trade when you're using mobile. You should only use mobile trading apps for monitoring your stock's performance and reading market news. So, to wrap everything up before we dive into the next section, what do you need to start investing? The first thing you'll need is education. You must first invest in your education. You'll need $10,000 to start investing, and then you can add $300 to $500 each month to build up your portfolio. Next, you'll need a trading account. You can open 2 trading accounts, one from TD Ameritrade and one from Interactive Brokers, so you can take advantage of the low trading fee from Interactive Brokers and have free access to the professional trading software from TD Ameritrade. And finally, you'll need a laptop with an internet connection to start buying and selling stocks. And make sure you avoid making a trade when you're on your mobile. Only use mobile apps for monitoring your stock's performance and reading market news. Okay, now I'm going to share with you my favorite trading strategy that you can use to easily determine stock market trends. I'll teach you how to buy high and sell higher. How this strategy works is simple. We'll buy a stock when it's in an uptrend, and we'll consider selling it at the end of the uptrend. So, how can we determine the market trends? In order to determine market trends, you can use the simple moving average crossover strategy. A moving average is a trend-following indicator, and it's created based on past prices. How the moving average crossover strategy works is simple. We'll use a pair of simple moving averages. We'll wait until these moving averages cross over each other so we can determine the incoming market trend. In fact, you don't need to draw these moving averages by yourself. Almost all trading platforms will help you do so. You just need to know what they are and how to apply them in your analysis. There are many different ways to use the moving averages. I personally prefer using the 180-day and the 60-day simple moving averages, simply because they seem to be more accurate than other moving averages. And the most important thing is, these moving averages work for me. Okay, here's an uptrend signal. When the 60-day moving average crosses above the 180-day moving average and both lines slope upward, this means that your stock is in an uptrend. So if you follow the trend to buy the stock, there's a high chance that the stock price will keep going up and you can make a profit. On the other hand, when the 60-day moving average crosses below the 180-day moving average, and both lines slope downward, this means that the prior uptrend has stopped and a downtrend will begin. In this case, you can sell your stock to get out of the market and consider buying it back when the trend reverses. Okay, now you know exactly how our strategy works. So how can you apply it in your analysis? First of all, you'll need to set up the indicators. I'm using the thinkorswim trading platform from TD Ameritrade. As I mentioned earlier, it's a professional trading tool that you can use to analyze stock charts. And the cool part is, this software is free. It's very easy to set up the simple moving averages. You'll need to draw two lines, SMA, or simple moving average 180, and SMA 60. Up on the right hand, click on Studies, and then select Edit Studies. There are a few tabs right here. Under Studies tab, type in Simple Moving Average. You'll see the Simple Moving Average indicator here. Since we need to draw two lines, the SMA 60 and the SMA 180, we'll add two Simple Moving Averages to the stock chart. Select Simple Moving Average and then click Add Selected twice. Because the default moving average time period is set at 9, you'll need to change it to 60 and 180. Double-click on each moving average and change the time period to 60 and 180 respectively. I personally prefer changing the SMA 60's color to blue and the SMA 180's color to yellow. You can use different colors if you like. After changing the time periods, simply click Apply and OK. When you do, you'll see the screen here. The software automatically helped us draw the two moving averages. Now, we just need to apply our strategy to determine the incoming market trend. Okay, now let's take a look at an example so you can understand clearly how the simple moving average crossover strategy works. As you can see from the chart, the blue line is the 60-day simple moving average, and the yellow line is the 181. Now, let's see what the moving averages can tell you about the market trends. When you analyze your stock's chart and you find that the SMA 60 is above the SMA 180 and both lines are sloping up, there's a high chance that the stock is in an uptrend. So, in cases like this, you can follow the trend to get in the market. However, when the SMA 60 is going to cross below the SMA 180, this may necessitate the selling of your stock. In this case, you'll need to pay close attention to the price movement of your stock. If the blue line crosses below the yellow line, and both lines are sloping down, this signals that there may be an incoming downtrend. As you can see on the screen, when the SMA 60 crossed below the SMA 180 at point A, the share price of Apple began dropping. And when the blue line crossed above the yellow line at point B, and both lines sloped upward, the trend reversed and the share price of Apple started going back up. The blue line crossed below the yellow line once again at point C, and you can see that both lines are sloping down. This signals that there will be an incoming downtrend, so it may not be a good idea if you're looking to buy shares of Apple at this time. Actually, we don't know what will happen with the stock tomorrow. However, the moving averages show that there will be a high chance that the share price will continue to drop until the SMA 60 crosses above the SMA 180. Okay, now let's take a look at another example, Starbucks Corporation. Firstly, let's take a look at point A. As you can see, the SMA 60 crossed above the SMA 180, and both lines sloped upward. This was an uptrend signal. The stock price kept going up until the SMA 60 crossed below the SMA 180 at point B. However, as you may notice, the two lines weren't sloping down. The blue line sloped downward, but the yellow line didn't. It was sloping up. So this tells us that there was just a short-term fluctuation, and the stock was still in an uptrend. Even though the stock price had actually dropped, it was just short-term. In cases like this, you can predict that the downtrend is just temporary, and the price will potentially go up again soon. As you can see from the chart, after the short-term drop, the stock price recovered and went back up quickly. Our strategy requires both lines to slope upward or downward so we can confirm the incoming trend. So if one of the two lines doesn't slope correctly, we will not consider it a valid trend signal. When the blue line crossed below the yellow line at point C and both lines were sloping down, we might consider this a valid downtrend signal. As you can see, the stock price continued to drop until the SMA 60 crossed above the SMA 180 once again at point D. Both lines started sloping upward, so we could easily predict that there would be an incoming uptrend. Okay, now let's take a look at another example, Papa John's International. As you can see on the screen, the SMA 60 was above the SMA 180. This means that the stock was in an uptrend. The blue line crossed below the yellow line at point A, but both lines weren't sloping down. This tells us that this was just a short-term fluctuation. The blue line crossed above the yellow line at point B, and both lines were sloping up, so you could easily predict that this stock's price would potentially go up. Looking at point C, the SMA 60 crossed below the SMA 180 again, and both lines were sloping down. In this case, you could easily predict that there would be an incoming downtrend. The SMA 60 crossed above the SMA 180 again at point D, and both lines were sloping up. So, this is an uptrend signal, and you could easily know that the stock price would potentially go back up soon. Okay, another example, Spider S&P 500 ETF. This is an ETF that's designed to track the overall performance of the S&P 500 index. Now, let's take a look at point A. The SMA 60 crossed above the SMA 180, and both lines were sloping up, so this was an uptrend signal. The blue line crossed below the yellow line at point B, and both lines were sloping down. In this case, you could easily predict that there would be an incoming downtrend. As you can see on the screen, there was a significant drop in this ETF's price. This was caused by the stock market crash in 2008. When the market crashed, many investors lost their fortune. Our simple strategy could have saved them from the crash if they knew how to utilize it. The stock market went back up again when the SMA 60 crossed above the SMA 180 at point C. Both lines were sloping up, so this was a valid uptrend signal. Looking at point D, the blue line crossed below the yellow line at point D. However, the yellow wasn't sloping down. So you could easily know that this was just a short-term fluctuation. The stock price would go back up shortly when the blue line crossed above the yellow line at point E. As you can see, our strategy's been working very well. If you can utilize this strategy, you can easily predict incoming market trends. And this is the key to your success. But wait a second. Don't just take my word for it. You can easily sign up for a free demo trading account from TD Ameritrade to test everything out. Sign up for a free demo trading account. You'll have 60 days for trying the thinkorswim trading platform. The demo trading account will come up with a virtual cash balance of $200,000, and you can use this money to test everything that you've learned so far. Go and test all the strategies that I've taught you. I guarantee you, if you can apply everything I teach here, you can get wealthy and build a better financial life. Here's what's inside the thinkorswim trading software. You can use this tool to practice buying and selling stocks. Try to make different types of orders. Buy different types of investments, such as ETFs, stocks, or REITs. Once you become familiar with the stock market and gain enough knowledge and experience, you can open a real trading account and start multiplying your money. So now you know exactly how to start making your money work for you. And I want to tell you an interesting fact. This strategy has been working very well for me, my friends, and thousands of my students. This strategy also works for stocks, ETFs, REITs, or any of your investments. And also, I want to guarantee you, what you've learned so far will work for you too. And finally, I want to thank you for learning with my video lessons. And thank you for spending your time with me over the past few days. Thanks, guys.